Mixed. The comeback kid, former President Lula da Silva, beats incumbent Jair Bolsonaro in the Brazilian election, signaling change for Latin America's largest economy. Plus, financing the turnaround, Credit Suisse is said to tap at least 20 banks for a capital increase to help fund another multi-year revamp. Let's take a look at these futures then, the final day of the month on a week. As we look ahead to a week that's expected to be volatile indeed for these markets, central as well for investors as we look ahead to that Fed decision on Wednesday, the BOE on Thursday, and next week, of course, US CPI. Let's check in then on how the markets are opening this Monday morning. The FTSE 100, and of course, within that, the basic materials part and basic resources part of the mix there will be in focus given what we saw in terms of the data out of China. Just a reminder that that economy is far from a recovery. The PMI coming in with a pretty solid miss there. Expectations from some that maybe the PBOC will now have to step up with further easing for the world's second largest economy. FTSE 100 currently range bound, just up by 4 points as things stand. The CAC going over in France up 0.1%. Over in Spain, a loss currently of 0.3%. A week of gains, of course, across Europe last week. 2 straight weeks now of gains stateside. Let's switch it over and see how things are playing out. See if the futures in the US are pointing to build on those gains. Not at this point, down 0.2%. The dollar is stronger, adding to that risk-off, slight modest risk-off sentiment that we're seeing in the first few seconds of the trade here in Europe, currently gaining 0.3%. The rally that we saw in US Treasuries last week, coming off slightly towards the end of the week. What will be in store later this week? Again, we're expecting 75 basis points. That is what investors are baking in from the Fed, but it's the signaling from Jay Powell that will be consequential as the front loading come to an end. We'll be listening to that language very closely indeed. 4.03 on the 10-year, the benchmark. $95 and weakness across Brent, down 0.6%, tying that back to the data story, the softer data out of China, and what that means for demand for oil going forward. Let's go over now to Bloomberg's MLive managing editor, Mark Cudmore. Mark, you're looking at China and US yields, and this is fascinating. I'm old enough to remember when Chinese yields were looking attractive versus their US counterparts, and that was pulling money into the Chinese market. No longer.
Yes, absolutely, Tom. I hope most people watching this show are old enough, because that was as recently as the start of this year. And this is what's been happened that's been quite momentous, actually. This is a chart of Chinese yields, 10-year yields, minus US 10-year yields. And you can see that for most of the last 12 years, to earlier on this year, Chinese yields offered a premium. And that was the idea that, as you mentioned, Tom, this idea that most of the past decade, this is going to bring more money into the Chinese market. It was going to increase the liquidity in the market, increase the amount of foreign participation, make it more liquid. Something's happened. It's changed. As recently as 2020, Chinese 10-year yields were over 250 basis points above US yields. Now, US yields have a premium of about 140 basis points. So about a 4% reversal over the last couple of years. What's happened? I don't really have the answers here, and I'm seeking answers from our viewers. I asked half an hour ago, and most people have just generally written in with the idea that Chinese markets are just broken. And I think they're broken in several ways. They're saying this is no longer a real market. Now, foreign participation is about 9.4% still. So not irrelevant, but way less than you'd think for one of the world's largest asset markets. And that's one of the things to remember is Chinese bond market is absolutely massive. So these should theoretically be comparable. But maybe they're not. And that's the other interesting point. Most most of this change has happened because of a rise in US 10-year yields. The movement in Chinese yields hasn't been that dramatic. Given the extreme kind of volatility we've seen this year across markets, given the negativity in China, Chinese yields are only down about 30 basis points over the past year. So is it becoming a little bit of a dead market? Is it becoming like JGBs? Are two of the world's three largest government bond markets essentially becoming broken and unmoving? I don't really know what the conclusion is. I'm trying to work out what the investment conclusion is. One point might be that the yuan has some lingering negativity, and because the PBOC steps in to control its currency a bit more, yuan is one of the few currencies in the world that tends to have a delayed impact from yield differentials. So most other currencies price in immediately. Whereas the evidence is that the yuan actually prices in slower and longer over time. And that's because the PBOC probably pushes back, so therefore it's a more persistent dynamic. And that probably suggests that there's some latent demand from dollars out of people, out of China, which we kind of know is the case. So yuan might stay weak for longer. But otherwise, I'm still looking for the explanation for this and what the investment conclusions are.
Just really, really interesting, as you say, if that is the consensus now, that this is a broken market, or if we're moving towards that as being the consensus, then that is such a significant narrative change amongst the investor community over the last 12 to 24 months or so. MLive Managing Editor Mark Cudmore breaking down what is happening with that lack of yield differential, at least the yield differential now, the premium of US Treasuries over Chinese debt, and how that is significantly reversed. Goldman Sachs now says it expects the Fed to raise interest rates to 5%, tying into that story, of course, by March. Jan Hatzius, chief economist of Goldman Sachs Investment Bank, says he thinks Fed Chair Jerome Powell will note that the FOMC aims to move deliberately but more cautiously now that the funds rate is in restrictive territory. He says the full impact of the US economy on the US economy of the very large tightening to date is not yet clear. Joining us now is John O'Toole, Amundi head of multi-asset investment solutions. John, let's get your call then. Good morning, and thank you for joining us this Monday morning. Let's get your take on that call by Goldman Sachs that 5% is now the terminal rate from the Fed by March, and yet 75 basis points this month, this is the call from Goldman, will be the last jumbo hike. They moved to 50 in December. Does that align with your view?
In our view, we would buy into that. A 5% terminal rate in the US does seem reasonable. This has been a very slow motion event and risky event if we think about how rate expectations have evolved over the last 12 months. We spent a lot of time talking about the Fed pivot and Fed actions. We must recall that only this time last year, the raging debate in markets was how many Fed hikes would we have in 2022? And the choice was between 2 25 basis point hikes or 3 25 basis point hikes. So you'll forgive me if I don't want to pin my shirt to the mast too clearly. But the direction of travel is the important thing for us. And the direction of travel remains clear. Financial conditions continue to tighten. They continue to tighten in rates markets. They continue to tighten in spreads. Moody's AAA, BAA spread has doubled this year from 60 to 120 basis points. The dollar strength is another headwind in terms of tightening. So the impetus is clear. We still think that this has some way to go.
Okay, no, we certainly forgive you for not wanting to pin your shirt to a clear call on this, given how difficult it has been to call the pivot from the Fed. But in terms of the language from Jay Powell on Wednesday, do you expect at least a softening, a slightly more dovish tilt? Maybe there is an expectation from some that maybe there will be some communication about the front loading of these rate hikes, and maybe that is coming to an end.
I think it would be extremely difficult to do so. And the reason is the following. Given forward guidance has kind of broken down, if you think, over the last 12 months across global markets, it would be very inconceivable almost that Powell would try to guide too aggressively, especially with, you have 2 payroll figures coming, one this week, you have 2 CPI figures coming before they meet again. So we believe 75 basis points is highly likely in December. It's well telegraphed, of course, and any downshift has to come in the context of a terminal rate expectation that's still rising. Consumers still have a big cushion of savings in the US. So the consumer has been quite resilient. We believe this is a drawdown in saving that's happening. Corporations have lowered their debt service costs. So for the Fed, a very resilient private sector seems to mean that the terminal policy rate may actually be higher than it had been. And considering the fact that they've embarked on very aggressive tightening, we would be very surprised if they roll back from this. They're still in the business of trying to tighten financial conditions. They have had limited impact on the employment market. And we believe unless and until you begin to see the impact of rising rates in the real economy via employment levels, the Fed will stay the course.
Where do you think that leaves then what has been characterized by some as this bear market relief rally that we've seen over the last few weeks?
We would be in that camp. I mean, and our positioning has been risk off. We've been short risk, given all of the headwinds that we see out there globally. You know, you mentioned in your piece about China, PMIs out overnight, sub 50% PMIs pretty much everywhere. So we still see a lot of trouble to come. As some of our US colleagues would say, the Fed still has some wood to chop in this environment. And we're cautious. We remain risk off. We would, rather than be buying dips, we'd be selling into this type of strength. And we do think that equities are an asset class that has yet to meaningfully reprice. You know, we've had a very meaningful reprice in fixed income markets, both rates and credit in terms of spreads. Equities, we still feel are susceptible to the reality of life hitting earnings. Earnings have been quite resilient. Every earnings seasons this year, we were expecting to hear some more negative forward guidance from corporates. It's beginning to come. And interestingly, we saw in Europe in the earnings season, we calculated 40 kind of downgrades and markets sold off by on average 15%. Yeah. So we don't believe markets have fully priced the earnings disappointment that may come from the real economy impacts that we all expect to hit.
Okay, selling into strength, not buying these dips. John O'Toole, Amundi head of multi-asset investment solutions, very pleased to say staying with us. We'll get more of his analysis after the break. Coming up, Ukraine, Turkey and the United Nations plan to resume grain shipments. This after Russia withdraws from a deal allowing safe passage. We've got the details up next. This is Bloomberg.
So let's go inside the boardroom. Let's suppose you win a proxy fight and or you just get invited onto the board. You go to your first board meeting and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we presented with the plan.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become chief future officers. Duke Energy has an ambitious plan to transition to clean energy, and new CFO Brian Savoy is ready to lead the charge.
We're going to invest $145 billion over a decade. There's a lot going on, but I wouldn't have it any other way.
Watch Chief Future Officer Wednesday on Bloomberg. To the world of business. Balance of Power with David Weston. News, analysis, insight from and about politics power players. Weekdays. This is Bloomberg.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia.
This is Bloomberg Technology.
Welcome to Bloomberg Crypto.
Well, I think the government is brand new.
So we obviously, many of the faces are very familiar faces, and we've been, in communication with them for many years, and we always are with the government. We await to see their proposals on taxation, on fiscal policy, on all aspects of it.
Where do you see the City of London being in 4 or 5 years? I mean, that's maybe too long a time frame. Should I say 12 months?
Well, it's both too long and too short. Here we are in the city, and this city has been the center of finance for 300 years. And it needs to be the center of finance for 300 more years. We certainly would wish that that were the case. And it is the center of finance because of an excellent regulatory system, transparent, fair. It is there because of great availability of talent and infrastructure, soft financial infrastructure and hard financial infrastructure. And a part of that is also a stable, predictable taxation regime. So we hope that all those elements and ingredients remain and continue to allow the city to flourish. And, the Prime Minister spoke about investing in education in Britain. And if you think about what drives the financial sector, I mean, you meet many of them. It's about the wonderfully trained people in the UK and the wonderfully trained people outside who are able to come and work in the UK.
I mean, the UK has lost something, or the City of London has lost business to other parts of the world in terms of, financial capitals.
Yes.
What do you need from the government today for that to be reversed?
Well, some of it is what others do, right? So once Brexit happened and you could not passport financial services to London, all the major banks had to set up trading enterprises in Europe. So that is irreversible, let's say, for the time being. I think other than that, what we need is a continuation of what London has provided. Education, infrastructure, people, great regulatory regime, and a stable and predictable, fiscal regime.
Okay, Bloomberg's Francine Lacqua, of course, sitting down with Barclays' CEO in his first interview since taking the helm of the lender last year. You can catch that full interview on your Bloomberg terminal or on Bloomberg.com. Let's switch focus from banking to geopolitics now. Ukraine, Turkey, and the United Nations have agreed to have food shipments continue to sail from Ukraine today. The continuing exports are a pushback against Russia after its withdrawal from a deal to allow safe passage of Ukraine's grain exports. Let's keep the focus then on what is happening with geopolitics and how they interweave with global markets, and bring back John O'Toole, the head of multi-asset investment solutions, who's still with us. We also had reports in the last hour of further Russian attacks on the Ukrainian capital, Kyiv. John, what is top of mind for you? What is top of the risk radar when it comes to geopolitics?
I mean, unfortunately, geopolitics is one of these things. It's a long play topic. The Ukraine war clearly has thrown massive degree of uncertainty. The energy price crisis that we see in Europe, the cost of living crisis, which may metastasize into a global food crisis. So the price of food, clearly, and the events overnight, this sudden withdrawal and the impact on wheat prices, these are long play events which, don't help the longer-term inflationary environment. China-US, more strategically, the China-US relationship, so the strategic political competition between China and US, China-Taiwan, and we saw the outcome of the Party Congress last week and the seeming consolidation of power. Allied to that, you have the midterms coming up in the US. So that cocktail of uncertainty and how that might play out is something that I think markets, it's difficult for markets to focus on. It's difficult to price. It will keep an upward pressure on the US dollar, we believe, as a kind of a safe haven asset. The war in Ukraine, unfortunately, our kind of base case scenario is a stalemate there. So again, it's one of these headwinds that make us feel it's not a great environment for taking directional risk in our portfolios.
Okay, and talking of the US dollar, gains of 0.4% to your point in the session today, John. I know you were telling us before the break that you're relatively cautious at this point. Where does it leave you? Are there pockets of this equity market where you want to be hiding out at this point?
Well, we can try to play the tactical game, and we're willing to do that. But like I said, any uptick in US equities we would take as a selling opportunity. we have had a relative position favouring US equities versus European equities for some time now, and that's been playing out favourably. We just think the US economy is clearly more robust than Europe. The authorities have more freedom, they're more active, they're prosecuting their agenda more cleanly, and they will get to a neutral rate quicker, we believe, than the ECB. So it's a more stable environment. Obviously, the deflationary pressures are beginning to kick in. In terms of the economic environment, the real economic environment. We really are quite concerned about the dynamic in US housing, for example. Even though it's a small part of the US economy, it does have a large multiplier effect vis-a-vis GDP and vis-a-vis household wealth. US households are the largest holders of US equities. So again, we're a bit wary that we haven't seen some bad flows that we may see coming through.
Okay, caution on the US housing market. Of course, looking ahead to the non-farm payrolls later this week as well, before CPI coming out on Wednesday of next week stateside. John O'Toole, Amundi, head of multi-asset investment solutions. Thank you very much indeed. Coming up, what next for Campari? We're going to speak to the CEO of the Italian drinks maker after pushing through a deal stateside. That conversation, the details next. This is Bloomberg.
Imagine simply climbing a cable into space. The concept is known as the space elevator. Not only could it significantly change how we leave planet Earth, but it could also completely transform humanity's relationship with space. And there are scientists who think we could have already built it.
We have the material, we have the technology, we have the lasers, we have the climbers, we have all of it. If a private entity wants to build it, or a government, they can build it. It'll change society. We have no clue how colonizing into space, how really spreading out into space will really change our society over the next 50 to 200 years. It'll be completely different.
Watch Bloomberg Surveillance Early Edition for the news you need when you need it.
I'm Matt Miller with Kaylee Lyons in New York and Anna Edwards in London.
I'm going to be watching retail earnings from both Home Depot and Walmart.
Then surveillance for in-depth analysis.
Alongside Tom Keane and Lisa Abrambitz, I'm Jonathan Ferro.
Across the board, these are good numbers.
And a big headline there is reaffirming the outlook.
How much does this give faith that you can get some sort of resurgence in consumer spending?
Bloomberg Surveillance. Be informed. Be prepared. Be ahead of the game. Welcome to the world of decentralized finance. Bloomberg's covering all things crypto. The people, the transactions, and the technology. Bloomberg Crypto, Tuesdays.
Welcome back to the Open. 21 minutes into your European trading day. European stocks currently flat, but you're seeing a gain of almost 2% in Campari. That company, Campari Group, has announced it has reached an agreement to buy a 70% stake, controlling stake in Wilderness Trail Distillery. The move will see bourbon become a second major leg after aperitifs for the Italian drinks maker. Joining us now is Bob Kunze-Konsowitz, the CEO of Campari. Bob, thank you for joining us this morning. Why does this deal make sense and why now?
This is a fantastic deal. Bourbon and American whiskey is a huge category in the U.S. It's roughly 13% in value of the U.S. spirits market, and it's growing very fast. Bourbon overall is growing about 7% a year, but the super premium end and upwards is growing by about 17%, and that's where Wilderness Trail is positioned.
What does it tell us then, Bob, what does it tell us about your ambitions for the US market, Bob? Because currently you get, 40% of your revenues from Europe. What does it tell us about the importance of the US?
Well, the U.S. is our largest market with about 28% of our sales, and it's our #1 priority. We've made most of our acquisitions to really penetrate even further the U.S. market, which is the largest profit pool in our industry.
So we should expect further deals in the US? You spent $420 million on this stake. Are you ready to pull the trigger on more deals stateside?
We always are. Acquisitions represent 50% of our growth, so we're actually on a good roll. This is our 5th deal this year. Obviously, it is the largest one so far, and it's very exciting because Wilderness Trail really premiumizes our offering. It's $55 upwards. It brings a tremendous amount of capacity, which we really need, distillation capacity, to satisfy demand. And it's also a very state-of-the-art facility, very flexible, which will enable us to innovate significantly going forward.
Okay, I want to kind of step back and get your views on the wider group, Bob, as we have the chance with you. You came in with a beat on the third quarter earnings. Talk to us about demand across the portfolio and how you see that demand, whether it holds up in the months and quarters ahead as we see these increased concerns about the cost of living crisis globally.
Well, I don't have a crystal ball, but currently our biggest challenge really is satisfying the demand which we see. And for that, we're making big investments in capacity. This is one in bourbon. Last week, we announced we're doubling the capacity of our plants in Italy to produce the aperitifs. Frankly, across our portfolio, demand is much, much stronger than what we're able to do, both from a production capacity standpoint as well as from a logistics standpoint. So we feel very good. Our brands are on fire. If you look at it, the off-premise has sort of slowed down or it's stabilized at a high level, particularly versus pre-COVID. And at the same time, the on-premise is very buoyant. On a total group basis, we're up 47% versus the pre-pandemic era.
Okay, so it's about meeting that demand. When it comes to the question of supply chains, Bob, where are the challenges most acute, and do you see them getting back to kind of pre-pandemic levels and resolving those bottlenecks that we've seen across supply chains?
The biggest challenges are in logistics, transocean, from the U.S. To Asia particularly, and from Europe to Asia. And then at the same time, domestically in the U.S., trucks don't always show up to pick up what they need to pick up. So we hopefully will see this improve in the months to come, but so far it's still a pretty tense situation.
Can you keep putting up prices, Bob?
Well, we've taken in selected market 2 price rounds, and if the inflationary pressure continues in terms of our raw materials, we will have to do it. And we're lucky enough to have brands with very strong brand equities and very loyal consumers.
Okay, Bob Kunze-Concewitz, the CEO of Campari, on that deal. Thank you very much indeed. The founders apparently started their friendship in the 1990s playing in a heavy metal band. The founders of Wilderness Trail Distillery, bought by Campari, at least a controlling stake, 7% for $420 million US. Campari, currently the stock up 2% on the back of that deal. Bob, thank you very much indeed. Coming up, the ADIPAC conference in Abu Dhabi is underway against the backdrop of a looming global recession and Europe looking for alternative supplies, of course, amid the energy crisis. We're going to be live from the conference next with an important interview. Stay with us. This is Bloomberg.
has identified its next big business, bringing advertisements to more parts of your iPhone. Today, Apple pushes ads in 3 places: the App Store, Apple News, and the Stocks app. In the News and Stocks apps, Apple shows display advertisements. That means that third-party companies like car dealerships or mortgage lenders can showcase their advertisements just like they can on a website. On the App Store, the situation is different. There, Apple has search ads. This allows developers to buy their way into showing up higher on search results. For instance, an App Store developer can bid for the term car racing or basketball so their apps will surface above competing apps in the list of results. Apple's push into ads is a little ironic, given that its ATT, or App Tracking Transparency Privacy feature, limits the ability for Meta, Snap, and even smaller developers to generate as much revenue as possible from advertising. That's because the feature allows users to choose if they want their data collected and tracked across third-party apps and websites. Still, Apple's hoping to expand its own ads business and is planning to add search ads to its Maps app. Other areas where ads could eventually appear are on Apple Books and Apple Podcasts, along, maybe one day, with an ad-supported tier of Apple TV Plus to compete with new offerings from Netflix and other streaming video providers. I'm Mark Gurman. This is Power On.
Innovation, money, and power collide in Silicon Valley and beyond. Bloomberg Technology with Emily Chang. Weekdays at 5 p.m. in New York and 2 p.m. in San Francisco.
Welcome back to the Open. We are 30 minutes into your European trading day, and here are your top stories. A higher high. Goldman Sachs now sees Fed rates peaking at 5% in March, boosting its forecast. Stocks, futures, and Treasury yields start the week mixed. The comeback kid, former President Lula da Silva, beats incumbent Jair Bolsonaro in the Brazilian elections, signaling change for Latin America's largest economy. Plus, financing the turnaround. Credit Suisse is said to tap at least 20 banks for a capital increase to help fund another multi-year revamp. We check in now on your markets. And the banking story of Credit Suisse is playing into that sector. You're seeing the banking sector currently, the last time I checked, at the top of the list in the terms of the sector. We'll break that down shortly. Broadly across the benchmark here in Europe, you currently see down losses of about 0.1%. It seems there's a lack of conviction. It could be a very significant week indeed for these markets, with the Federal Reserve, of course, the expectations. So they're going to go with 75 on Wednesday. But more importantly, arguably, is the guidance from Jay Powell and whether he suggests that the front-loading of hikes is coming to something of a conclusion. Goldman Sachs raising their terminal rate forecast, but they do expect 75 this week, followed by 50 basis points in December. The DAX currently down 18 points at 13,225. The FTSE 100 off by 0.2%, of course, with the BOE and their decision coming on Thursday. Let's get back to the energy story, though, and what is happening, of course, the analysis and the views out at ADIPAC, the conference underway in Abu Dhabi. And Manas Krani, of course, our Daybreak Europe anchor, is on the ground, and few people better placed to walk through this story for us. Manas, you're with a very important guest for us this morning.
Tom. We are indeed. A very patient energy minister from India joins us here at ADIPEC 2022. It's Hardeep Singh Puri. Good to have you with us, sir. I saw you on the stage with the Saudis. I know you have your private bilaterals. You're a big buyer of Saudi oil. Have you expressed any form of disappointment or dissatisfaction with the cut they've just done?
I have always maintained, this is not only my personal view, but that's the view of people in my government, that these are sovereign decisions. Anyone who is a producer has the sovereign right to decide whether he wants to produce, sell, retain the thing, but we also tell them, and I've missed no opportunity to point out, that every action that we take has consequences, both intended and unintended. Now, insofar as the unintended consequences are, let me tell you, if you keep the price of oil at a particular level after the devastating economic consequences that the world had to face after the pandemic. $20 trillion economic stimulus in one country,
yes,
back-to-back, quarter-on-quarter, negative rates of growth. So when I was here in ADIPEC last year, people were talking about rectifying the supply and demand equilibrium, rectifying. Yes. And that said by February it'll be over. It's gone the other direction. But what has happened is, today the atmosphere here is far more subdued. It was more exuberant last year, and now people are talking about high oil prices, not only fueling inflation, but the big R word.
Well, the recession risk. If we look at where oil has done in the past month, it's up 10%, okay? We're trading strongly. Where is the most uncomfortable level for you as a buyer of crude? What is it that breaks you? What price level are you going to flash red at?
No, first of all, I'm not in the business of flashing red at. My moral duty is that we have a population of 1.34 billion people. We have not allowed the availability of petrol, diesel, other fuels to reduce even by a day. So what have we done? We've reduced the government's excise duty at a time when the government of India was feeding 800 million people 3 meals a day, which they're still doing. Dry ration. We kept the price of petrol on the bunk. You know, 60 million people go to the bunk every day. And the price of oil has not gone up in India. Why? We have taken a beating.
Well, you've taken the beating, but here's the point. There's a wonderful line His Royal Highness used this morning, and it reminds me of an Irish phrase, me fain, me first. Saudi Arabia has said, we don't owe anyone anything. Is it India first? Are you India first? You'll buy oil from wherever you need.
I will tell you two things. We're a 5,000 or 7,000 year old civilization, okay? I don't want to comment on what anyone says, but what I can tell you, we have a moral duty to supply energy, and we have taken the steps. One of the good unintended consequences of this has been that the acceleration to green energy has been pushed on the upfront. Let me give you two examples. In the last year, 2 years, billions of dollars have flown into the electric vehicle ecosystem. You know, we did an analysis. How much energy are we consuming on our roads? And 70% of it is by two-wheelers and three-wheelers. And they're all on replaceable batteries. You know what Mark Rich did in the early 70s? He put buyer and seller in touch. You know what they're doing now? The new energy people, they're putting lithium producers and buyers in touch. There are fascinating things happening there. And I think we will benefit from that. We will not allow shortage of energy. If there's a problem from one source, we'll go to another source.
Okay, which takes me to, can you confirm the G7 price cap, you definitely won't sign up to that?
You are asking a question and you're answering it yourself, so I leave it at that. I leave it at that.
Will you sign up to a G7 price cap, Minister?
First of all, it is something that the correct diplomatic thing is for me to say, we'll examine it. But let me tell you two things. Those who are receiving energy through a pipeline, example Hungary, excluded. And those who are receiving it by a pipeline, China, excluded. Japan has got an exception. So whom is the price cap intended against? Let's leave it at that for the moment.
Okay, well, let me talk about the flow and the price that may come to bear for you from Russia. Have you agreed any new contracts with Russia post this new set of sanctions that are due to come into place?
First of all, I don't do the contracting. I've got oil companies who do it. And my oil companies don't wake up in the morning and call me, what do you want to have with breakfast? 2 million barrels more from Russia or 3 million less from somewhere. We don't work like that. This is a complicated world, my friend. Who buys from whom, I find out later. Let me give you some statistics. In the few months up to September, we had some constants. One particular supplier in the Gulf was #1 all the time. I suddenly find they've got #3. Another supplier has become #1, and meanwhile, the Russians have moved up. But the Russians also don't give you. The oil companies will buy wherever they can at the cheapest price. This is the first point. And it's not a simplistic world that one guy is giving the discounts and the others are raking in the premium.
Okay.
They're all in the game together.
You talked about the unintended consequences of actions. The unintended consequence of a cut of 2 million barrels a day has left us with Saudi-US relations, I would say, at a very fractured moment. How would you describe?
It's your description, but I don't.
That is mine. I want yours.
I
want yours. How would you describe Saudi-US relations then post the 2 million barrels a day cut?
Listen, my friend. I happen to be in Washington, D.C. for discussions with the Energy Secretary of the United States, Jennifer Granholm.
Yes.
A day or two after this 2 million barrels cut was there. What she said to me, I'm not going to repeat to you here. Or what I've seen statements made by other U.S. Senior advisors, etc. Let's leave it at that. I think this is something which will play out. I think this is something that will play out. There is a very dynamic world. By the way,
do you think it'll de-escalate? Do you think we need? Do you think that we need a moment of reflection and de-escalation?
I belong to the world of diplomacy. My premium always is on talking, on sitting down. I'm, excess patience and getting things resolved. But let me mention one thing to you, which you may or may not this thing. Many of the dramatis personae in this base their reactions on what they have been given to expect. So issues like disappointment or whatever is a direct consequences what they were expecting. So were they taken aback? That's one thing. All I'm saying is I never bought energy from the United States earlier. I had $160 billion of bilateral trade. Today I'm buying $20 billion of energy from the US now. I will buy from wherever I have to. If you have a little money and you want to invest, would you like to invest in Ireland? And we probably will co-invest with you in Ireland to get oil to India.
There's oil off the coast of Cork. Let's finish with this. Everybody sits in this seat and they've said to me, tight markets, higher prices. Amrita Sen tells me $100 oil. Come on, you've got to have a view in terms of how tight these markets are and where's the risk in this market. Is it to the upside towards $100?
Do I look the kind of person who's worried? I'll tell you, if somebody thinks that they can raise the price from there, what happens? You raise the price from there, the only response is that the recession will be deeper and prolonged. So it's in their interest not to allow it to go beyond that. I heard a statement by the energy minister of the UAE. You were also there. Didn't he say if demand goes up, we have our options open? Does that mean they'll produce more? Look, this is a game in which you don't need to get unduly concerned. You have to take into account all the evidence which is coming at you, how many people are participating in that cut in production. You have to see how the world moves forward.
I'm not on duty concern. Minister, thank you very much. Time has run against us. Hardeep Singh Puri, Minister of Energy for India, on form and ready to invest in Ireland. I'll give the IDA a quick call. London.
Manas, that's got to be the most entertaining interview of the day. Thank you very much indeed. Manas Krani on the ground at ADIPEC with India's Minister of Petroleum and Natural Gas. Just a redhead that crossed the line during that interview. Hong Kong's third quarter GDP contracting 4.5% year on year. The estimates from the economists had been for a contraction of just 0.8%. So pointing again to the pain in Hong Kong, the third consecutive quarter of contraction for that city. We'll bring you more details if and when we get it. Coming up, he is back. Lula da Silva narrowly beats incumbent Jair Bolsonaro in Brazil's presidential elections. More on that story next. This is Bloomberg.
If you do any kind of business in this country, there's a pretty good chance that you're going to see that business registered in Delaware. Why? Because that's where you do it. And our point was Wyoming can be that venue for blockchain enterprise, for crypto.
It's not the Wyoming way to sit around and wait for change. We want that independence, we want that freedom, we want that individuality. And that's a common theme that brings together bipartisan support for this in Wyoming.
We want to make sure that people understand, especially in Wyoming, but as the United States as a whole, this trend is coming. It's not going to stop. This is more of a small town that's growing into what I would call the cryptocurrency version of Silicon Valley.
It's the philosophy of that rugged individualism, the independence, and the ability to really get things done for yourself and control your own destiny. You get that from a blockchain, and you don't get that without it.
You will shed light on dark matter. You will make aging optional. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
We're in the iconic Avenida Paulista in Sao Paulo, where Brazilians are out in full force celebrating the election victory of former President Lula da Silva. Many still remembering the prosperous economic times during his 2 terms as president, where he enjoyed a commodities boom. This time around, though, he could face bigger challenges, including a global economic recession, improving the fiscal outlook, as well as uniting a divided people. Sherry-Ann, Bloomberg, Sao Paulo.
Bloomberg Sherry-Ann reporting from Sao Paulo following Lula's victory there. And let's get more details with Bloomberg's Rodrigo Orihuela. Rodrigo, what does Lula's win mean then for South America's largest economy? It was a close-run fight.
Yes, it was a close run, that's for certain. Both candidates had huge rejection levels, so it's a very tight election for Lula. He will really have to work closely to control or to get support from Parliament. That's the big question mark, number one. Number two is he built a broad coalition with people who were traditionally his rivals. Even his Vice President, Geraldo Alckmin, was his main contender in one of the previous elections, and he brought them on board. The question is, will this continue? Will this sort of big front remain in place during his government? Because that also will send some strong signals as to whether he's more pro-market or he goes more towards the left of his party, as sometimes occurred in the past. So that's the big question mark.
Okay, Bloomberg's Rodrigo Orihuela on the latest when it comes to this election win for Lula da Silva then. Of course, Jair Bolsonaro, the former president, yet to officially concede. But let's get the analysis now with Luis Costa, Citigroup's Global Markets Head of CEE EMEA Strategy. Luis, thanks for coming on. Let's start with the top line then. What does it mean for Brazilian assets, this win by Lula da Silva?
I think it confirms something that was already at least partially priced in. But I think that Rodrigo's intervention was spot on. I mean, it's going to be very important, and we are not going to get the final conclusion right now over the next 24 hours. It's what is going to be Lula's cabinet? What is the shape of Lula's cabinet, given the fact that, he signaled a move to the center left by allowing Alckmin as his running mate. So it's going to be very important because that would give us an indicator of what policies will be like. I think that's the major challenge here. We know that there's a social bias and there's a fiscal challenge coming due. And what it's going to be like in terms of how market-friendly can this government be, given the promises and the natural PT bias now.
And he's talked about the need to heal those divisions, obviously the deep divisions within Brazilian society that were reflected in those results. So we're looking for the cabinet makeup, the makeup of his economic team as well. There's an argument that this will be a more centrist Lula, given the fact that he's hemmed in to some extent by the opposition in Congress?
I believe yes. I believe that there is a tendency to compromise, and that's exactly what he did. I think it was a fantastic move at the beginning of the year to invite part of the opposition to form a running ticket. So I think that was probably one of the major winning moves, ahead of the election that actually, promoted his candidacy. And the shape of the vote is very split. 51%, almost 51% against 49%. So, and knowing that, of course, that the Congress is still very much strong when it comes to a Bolsonaro dominance. So, forming policy and enacting policy will be a challenge.
And on that point, what are the policies you're looking for in terms of the priorities and those policies that are most likely to be implemented then?
Listen, I think that, Brazil, as we know, always battle with the fiscal matrix, the fiscal side. This year hasn't been the case because, growth overperformed a little bit compared to expectations. Inflation is always good news in terms of revenues, but we know that this reality might as well change as we go into 2023, 2024. So it's going to be very interesting, very important for Lula to signal, hey, I'm still abiding by the terms of the trade. All the promises I made, but I'm by the same token, I'm trying to keep some fiscal austerity here. And it's a very difficult challenge. It's going to be difficult, especially if growth falters along the way.
Brazilian assets, just before we let you go, they've outperformed their developing market peers. Valuations for many look attractive. Interest rates look pretty compelling as well. Do you expect that outperformance to continue? How contingent it will be on that makeup of that economic team in the cabinet?
I do expect the next quarter at least. I do expect, especially Brazilian bonds, Brazilian rates on the rate side to continue to attract. Obviously in a very difficult background for the emerging market assets, but it's a story of a central bank that is becoming more neutral. It's a story of an inflation finally giving, visible signs of some sort of a turnaround. So this is very positive compared to other parts of the emerging markets where central banks are still tackling or trying to tame the inflation side. So Brazil was one of the first to hike rates aggressively almost 2 years ago. And it's probably now reaping some fruits in terms of attracting some capital. So we do like the rates to receive rates and to buy local bonds in Brazil. I think that's probably the main trade here.
Really, really important analysis on this day. Luis Costa, thank you very much indeed for coming to the studio, breaking down the story and the implications for Brazilian assets there. And of course, Citigroup's Global Markets Head of CEMEA strategy. Coming up, Credit Suisse is said to tap 20 banks, to raise $4 billion in a rights issue. We're going to bring the details next. The stock is gaining on that story. This is Bloomberg.
Knife making is almost meditative for me. There's a lot of passion behind it. There's a lot of hard work behind it. And it's not just something that you kind of just brush off like, oh, this is just a knife. People's hands touch this knife. People pour their passion and their soul inside of these products.
The art of blacksmithing has a very long history. Our notion of what it means to be civilized is to have metallurgy, to have the ability to transform the natural world.
when somebody used my knife, I want them to see, damn! Golly, this is a badass knife. Come here, let me show y'all something.
To the world of business. Balance of Power with David Weston. News, analysis, insight from and about politics power players. Weekdays. This is Bloomberg.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan. We did see some pressure on the futures. That is now being reversed.
Additional equity is out of the question. We have stated that we like where we are at 9.9%, and at this stage, we're not interested in becoming and moving from being just a tactical investor into a shareholder, even into a different category of our relationship with Credit Suisse.
Saudi National Bank chairman speaking to Bloomberg TV there about the lender's commitment to investing in Credit Suisse. That after Bloomberg learned that Credit Suisse has invited at least 20 banks to take part in its $4 billion rights issue. Sources say Goldman Sachs, Citigroup, Wells Fargo and JP Morgan, you can continue with the list, it is long, are amongst those being courted. Joining us now is Bloomberg's Jan-Patrick Barnett. JP, 20 banks for $4 billion, it sounds like a lot. Why is it?
Well, Credit Suisse certainly wants to make sure that this is going well, because it's the first step in their whole restructuring plan that has to work. And so the more banks you pull in, the more likely it is that they find enough interest in investors who want to participate in the capital raise. So it makes kind of sense that you have a huge pool here, though I would say like 20 is really like an excessive amount, but it's not clear yet if all of them will stay on board going forward.
Yeah, Credit Suisse shares up 2.2% in the session today. What do you think it means for the share price going forward, Jan-Patrick?
I mean, we have seen like a big drop here last week after the announcement. So the big questions are now like how many investors want to participate in the capital raise, and how much more details do we get from the management about the restructuring? Because there are still some open questions. We want to see what the analysts are going to comment going forward. It's a huge dilution of something between 20 and 30% of existing shareholders. So I would assume that besides some maybe like technical short covering of those who have betted against the stock, we won't see like much upside. It's probably going to move sideways from here until all the dust has settled.
Yeah, that's painful, isn't it? 20 to 30% dilution for existing shareholders. JP, what else are you watching for when it comes to the Credit Suisse saga?
We want to see how this ends up. So the whole capital raise should be completed in early December. So we want to see that. Then we want to see more details on how they want to save costs. That's a big thing. And then a very important, because that's core of the restructuring and core of the business model going forward. And so far, they failed a little bit to explain on how they want to rebuild the trust that has gone lost.
JP Barnett, we lost you for a bit there, but you came back with full force. Thank you very much indeed with the take on Credit Suisse. We appreciate it as ever, a story that we continue to watch for you. Across these markets, the European benchmark currently down 0.2%. Futures in the US as well. The S&P E-minis down 0.6%. NASDAQ futures down 8 cents. After, of course, the context is 2 straight weeks of gains for US equities. We look ahead to that important decision from the Fed on Wednesday. The guidance from Jay Powell will be central. You have the BOE on Thursday. You have the jobs data on Friday, and CPI out of the US midweek next week as well. A central 7 to 10 days for these markets. Futures stateside, again, pointing lower. Stay with us. Surveillance Early Edition is up next. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
No one covers the world like Bloomberg.
Because Trustonomics is being dismantled, MPs behind the scenes are asking, what's the point of having her at the top?
Can the strong dollar amplify the world's risks of instability?
Xi Jinping said complete reunification must be realized.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. Welcome to the world of decentralized finance. Bloomberg's covering all things crypto, the people, the transactions, and the technology. Bloomberg Crypto, Tuesdays. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers Jobs Day like Bloomberg.
To justify.
The one thing the Fed cannot afford to have anyone say is they're not credible.
Frankly, the Fed doesn't listen, and if anything, feels more pressure to prove its independence.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kaylee Lines.
It's 9 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. A crucial time for stock traders. 4 major events in the next 7 days could shape the market's outlook for the rest of the year. We'll have a briefing. A dramatic comeback in Brazil. Left-wing politician Luiz Inácio Lula da Silva is re-elected president 3 years after he was in jail on corruption charges. And the price of wheat soars after Russia pulls out of a deal allowing Ukrainian exports. Meanwhile, Ukraine says that Russia has launched a massive wave of missile attacks. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Katie Greifeld and Kaylee Lines in New York. Matt Miller is off today. And Kaylee, I feel closer to you in a number of ways. We have fallen back here in Europe. You have yet to fall back in the US. So we're only separated by 4 hours. But also our market's moving pretty much in step today. European stocks move lower as US futures retreat.
Yeah, what's interesting is you didn't see a wholesale move lower in Asia overnight. It really was a bit of a mixed session. The MSCI Asia Pacific Index as a whole actually was positive on the day, rising by a little more than half of 1%. But you had stocks down in Hong Kong as well as in China, where we got some weak economic data in the form of manufacturing PMIs in contraction territory and coming up short of economist expectations. You also are in contraction territory when it comes to the services numbers, so that pointing to weakness in the Chinese economy. As a result, you are seeing a weakening in the Chinese yuan, the offshore yuan in particular, weaker against the dollar by 0.7%. We're trading at 7.32, and of course playing into that is the PBOC setting a weaker reference rate for the yuan for the second day in a row. You also have weakness elsewhere in Asian currencies, including the Japanese yen. It is about policy divergence between the Fed, which is set to hike another 75 basis points this week, and the BOJ, which is doing nothing in the form of hiking. So as a result, dollar yen trading at 148.28. And then I wanted to point to one ETF that traded in Japan overnight as well, an ETF that tracks Brazilian assets higher by about 3.3% after Lula beat Bolsonaro in the Brazilian election. What is interesting, though, is if you take a look at pre-market trading in the U.S. and North America rather than in South America, the MSCI iShares Brazil Index, that ETF is down about 4.3% in pre-market trading. You could argue that the move in Japan was a little bit more of the follow-through from Friday's rally in Brazilian assets, Katie, but this Brazilian ETF and U.S. U.S. pre-market down more than 4%. So we'll have more on that election outcome in just a moment. But what else is going on in terms of U.S. trade?
Well, if you look at pre-market action, it's pretty risk-off. We're looking at S&P 500 futures down 0.6%. Tech futures down even more than that. This move has accelerated just in the last hour or so. It comes after a big, broad rally on Friday. The S&P 500 had rallied more than 2.5%, taking a bit of a breather this morning. You see how that filters into the bond market. You have U.S. 10-year Treasury yields moving higher, 5 basis points or so. That was a 9 basis point move on Friday, so a continuation of the bond sell-off. And I did want to keep an eye on wheat, of course, after Russia pulled out of that grain export pact. As you would guess, wheat futures climbing as we watch here, up 6%. That move had been about 8% higher a few hours ago, Anna. Not a great sign for what's already a global food crisis.
Yeah, so we're seeing the markets respond to those geopolitical developments then, Katie, even though other parties to that agreement signed back in the summer seem to be trying to persist with it. This is the picture for European equity markets, and as Katie set out there, some weakness in US futures, that's been increasingly weighing on the European story here. We tried to catch up with the gains from Friday on Wall Street, but failing to really build on those, and the FTSE down 0.1%, the CAC down 0.3. Interesting to note, the FTSE MIB is fairly flat over in Italy today, and we've just got some data, preliminary data on GDP out of Italy. Third quarter GDP rising by 0.5% quarter on quarter. That is growth of 0.5%. The estimate was for that number to be entirely flat, and this is a higher number than any of the economists surveyed by Bloomberg had expected. So it just goes to show the difficulty in forecasting growth right now, and also raises really interesting questions. A lot of this was to do with the services sector, it seems, from reading some of the detail, but interesting questions nonetheless about what happens to the European growth story if the winter is milder than we had anticipated, which seems to be something that is getting a lot of attention of late. And with that in mind, we see another drop in natural gas prices here in Europe, down by another 7%. We've got natural gas prices moving in all kinds of different directions around the globe. The US story is very different, and perhaps this is a little broken now, given what we know the European Union is trying to do with this particular benchmark. But if it reflects that milder weather, that is something of a positive for the European growth story, perhaps. The euro is at 0.99. I put this in because we've got that data out of Italy, which is interesting, but also in a few, where are we? 55 minutes time, we'll get inflation data out from the Eurozone. Will that, Kaylee, come in at 10.3%? That's the estimate. The last time we got a reading of 10%. Credit Suisse up by 2%. We'll get some more details on this one. They've hired a number of banks to try and help them with the capital raising they're doing, and some confidence from one particular investor coming through in Saudi Arabia. And NatWest up by 2.3%. An example of a rally we're seeing, Kaylee, today in UK banks. A lot of weekend press newspaper coverage suggesting that perhaps the government won't try to put another windfall tax on the banking sector. That is certainly what the markets are responding to today, Kaylee.
All right, Anna, so certainly a lot going on in the European region, but let's get back to the story in South America, specifically Brazil. Luiz Inácio Lula da Silva has won Brazil's presidential election after narrowly beating Jair Bolsonaro in a dramatic comeback. Lula defeated the incumbent with 50.9% of the vote. He spoke after his victory.
We didn't face a candidate. We faced the machinery of the Brazilian state, put at the service of a candidate to avoid us winning the elections. Thanks to the Brazilian people, to the people who voted for me, and to the people who voted for my adversary.
Bloomberg's Sherry An is joining us now from Sao Paulo for more. She's been reporting on the election all weekend. So, Sherry, it turned out to be a very, very narrow victory for Lula. But what about Bolsonaro? Has he conceded defeat yet?
Not yet, and we're watching that very closely if the incumbent president is going to come out and accept the results. Of course, the fear is that he may not. He's repeatedly cast doubt on electoral authorities with a really narrow victory, as you say, with a margin of less than 2 percentage points. This is the narrowest presidential win in 40 years since Brazil's return to democracy. So, of course, we're watching what Bolsonaro does next. Still, we haven't heard from him, not even commenting on the results. Local media saying that he's been unavailable even to his closest allies. This did not stop Lula supporters, though, from coming out in full force in the iconic Avenida Paulista. This is one supporter telling me how he's very optimistic about the new government. Take a listen.
Today it's a great day for Brazil. Now we elected a new president that we get our expectation for new era for the next 4 years.
Congratulations have started to roll in from world leaders, including President Joe Biden, who called the election free, fair, and credible.
Well, Sherry, turning to the markets, we have some clues from the ETF world, but how are we expecting Brazilian assets to react?
I mean, they have really outperformed global peers this year. And yes, you said it, with those Brazil-related stocks trading in Asia gaining ground, perhaps we might see a pop when Brazil opens in just a few hours. Analysts saying that the victory was clear enough to give Lula the presidency, but perhaps not strong enough for the leftist president to turn more left in his economic policies. Of course, we are watching very closely what the composition of his economic team will be, and perhaps more clarity on his fiscal proposals as well, something that we did not get in his victory speech. He did say, though, that he wanted to reunite a very divided country, that he wanted to end hunger again while attracting foreign investors.
Sherry, thanks very much. Bloomberg's Sherry Ann reporting there from Sao Paulo with the latest on Brazilian politics. Let's get back to European geopolitics. And wheat surged after Russia pulled out of an agreement to allow grain exports from Ukraine through the Black Sea. A deal seen critical for easing tight world supplies, a deal that was signed back in the summer, of course, along with the United Nations. Now, Mark Champion, our senior reporter for international affairs, joins us now with more. Mark, and it seems the market not sure how long-lasting the impact is going to be here, but from a geopolitical perspective, we are seeing some ships, it seems, still trying to carry on as if nothing had happened. What's the read across from what Russia is saying here?
Well, we need to wait and see a little bit. Obviously, it's quite a process where these ships line up, they get inspected, they go into port, they collect the grain, they come out, they get inspected. So, the moment that the Russians say, we're pulling out of the deal, there's a lot of ships on the move already. So they import. And what's happening at the moment is that those that have been loaded, those that were, in port, that were past the inspection, those are coming out. And we don't really know how the Russians will react. But it may be that they're just going to let the ships that were already loaded, already in port, inspected and so on, allow those out. And then we'll see what happens next.
Well, and Mark, meanwhile, the war rages on. Ukraine saying this morning that Russia has launched a massive wave of missile strikes across the country. What's the latest there?
Yes, it was another really big set of strikes against infrastructure. You had cities without power, water disrupted, and really, a message again. This is the second time now where the Ukrainians hit Crimea in some form. This time it was the Black Sea Fleet. And then the Russians have responded with a massive set of missile attacks. So the Russians seem to be, making a very clear point that in their view, Crimea is off limits for this war.
Mark, thank you very much. Bloomberg's Mark Champion with the latest on that geopolitics. Let's get back to the banking sector. Credit Suisse has invited at least 20 banks to join the syndicate for a $4 billion rights issue that should help the lender finance another multi-year restructuring program. Bloomberg's Tom Metcalf joins us now with more. And Tom, good morning to you. So we heard about the restructuring last week. We heard about the capital raise last week. Now we get a sense of just how many participants there are in this and who's being asked to help. So what do we know about this rights issue?
Yeah, well, the thing that really jumps out is just how many lenders they're getting involved. At least 20. I mean, it's basically everyone on Wall Street. So, and that's for $4 billion. So that's kind of interesting. It suggests, obviously it's a very prestigious thing to join, but also perhaps that the banks are looking to spread the risk among themselves. Obviously, they would lose money if Credit Suisse shares fell any further. And then the other thing about this rights issue, of course, is that the Saudi National Bank has taken up to a third. And I think earlier today on Bloomberg, they were saying we're not going to take any more than a third. So that's kind of where we are right now.
And Tom, zooming out a little bit, how would you say this reboot overall is being received by the market?
Well, on Thursday, there was not many fans of it. It was down, I think the Credit Suisse shares down about 19%. They've recovered a little bit on Friday. But yeah, largely I think there's a little bit of disappointment that perhaps it wasn't quite as sort of fast moving and as sweeping as people felt. So I think there's just a sense that, gosh, this might, continue for even longer than we thought.
Okay, Tom, thanks very much. We're back. Tom Metcalf with the latest on Credit Suisse and that particular saga. We will keep that under review. Coming up on the programme, Amanda Agati joins us, PNC Asset Management Group CIO. So much to talk about this week, from the FOMC midweek to the Bank of England on Thursday to the jobs report on Friday. And I'm sure I've forgotten 5 or 6 other things that I should have mentioned. We'll also talk about crypto, Musk's crypto push, in fact. We'll discuss what changes may be coming to the platform under the new management. Plus, we sit down exclusively with the Barclays CEO in his first TV interview since taking the helm of the UK lender. Part of that conversation ahead.
Bank liquidity, I don't think, is an issue. We've had liquidity regimes. Funding models are much, much more robust than they were in the financial crisis. I think part of what people are worried about and what they saw in the gilt market was the liquidity in underlying trading.
Go.
After hardly a full year of name, image, and likeness deals being a reality, UCLA quarterback Chase Griffin already has more than 20 deals with major brands, venture, and charitable groups, all while balancing graduating undergrad in just 2 years and fighting for playing time on the field.
Chase Griffin out of the gun.
We are joined by UCLA quarterback Chase Griffin, not just UCLA quarterback, but name, image, likeness superstar. I am psyched for this one.
This kid could actually be the president of the United States someday.
When it comes to building generational wealth, it's not about the money that you make in college. I'm very excited that I made the amount of money that I made last year. I am even 10 times more excited that I know how to make that money.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become chief future officers. Duke Energy has an ambitious plan to transition to clean energy, and new CFO Brian Savoy is ready to lead the charge.
We're going to invest $145 billion over a decade. There's a lot going on, but I wouldn't have it any other way.
Watch Chief Future Officer Wednesday on Bloomberg. Markets expect another rate hike.
Investors obviously skittish.
What the Fed do on November 2nd is key to everything.
But where will the Fed go from there?
No sign it is ready to stop tightening.
Everybody talking about a step down.
They're going to wimp out and they're going to blink.
Trust Bloomberg for the fastest coverage and exclusive analysis.
Do we want this Fed to force a recession?
The Fed's going to torpedo momentum.
In markets like this, everyone's a long-term investor.
Bloomberg Surveillance. The Fed decides. Wednesday on Bloomberg. Your global business authority.
This is Bloomberg Surveillance Early Edition. I'm Katie Greifeld with Kelly Lyons in New York and Anna Edwards in London. Matt Miller is off today, and it's a heavy news week. Front and center for me is the Fed meeting on Wednesday. Let's take a look at where U.S. equity markets stand as we head into that all-important meeting. You're looking at a ratio of the S&P 500 to the tech-heavy NASDAQ. And what caught my eye is that relative to the S&P 500, it's at a pre-pandemic high relative to big tech. It's like the pandemic never even happened. As you can see, this is a trend that has been building all year, and it was this latest round of tech earnings that finally pushed us here. I want to talk about this with Justina Lee. She is a Bloomberg Markets reporter. And Justina, as we count down to Wednesday, how much potential more pain could there be for big tech?
Yeah, I think that is the question right now. I mean, I still remember a few years ago when big tech stocks was considered the stabilizing force in the market, but that's really completely changed now to the point where we're actually looking to these stocks for signs of, slowing consumer demand. I think one thing that's kind of been interesting is that with that big hit from these tech earnings, investors actually haven't really been paying that much attention to kind of what bond yields mean for these tech stocks, because usually a bond rally is good for these names, but that actually has not been good enough to help these stocks last week.
Yeah, I mean, some of the corporate reporting was pretty dire, wasn't it? Not all of it, Justina, but some of it, and that seemed to be the focus. Thinking about where we go on bond markets right now, there seem to be a lot of twists and turns that could be in the way of the bond market this week. I talked to one of our colleagues on the Markets Live blog earlier who was saying you might get a dovish FOMC and then you might get a hawkish jobs report, and that could whipsaw bond markets. What's your expectation?
Yeah, exactly. I think everyone's pretty sure that we're going to get the 75 basis point hike this week. But what everyone is paying attention to is what the Fed is going to say about, the next meeting. And we had this huge bond rally last week because people are starting to think that maybe they're going to step down the language for the December meeting. But, as we've kind of seen from the inflation reports, out of Europe, despite kind of energy prices going down and kind of with, the U.S. data that's coming out, it seems like we're not necessarily kind of, past that, inflation worry phase yet.
Yeah, and inflation, in fact, we get, Kaylee, we get inflation data around the Eurozone at the top of the next hour.
Yep, and we'll be getting inflation data here in the U.S. next week, 2 days after midterm elections, so a lot of potential catalysts for this market. Justina, there was a conversation, though, that inflation was going to start to really bite corporate earnings. The pricing power was going to disappear as demand starts to fade. What is your takeaway from earnings season so far, now that we're halfway through it? Is it as bad as we were all anticipating? I think what I read from one strategist today is that, apart from the mega cap tech, in a way, it hasn't been as bad as kind of everyone expected. Of course, it was still bad, but in the sense, maybe expectations were so low that people felt a bit of a relief, kind of, and that's why we've had this rally in the S&P 500. But I think one interesting thing this season is we've had huge reactions, to both beats and misses, and that's a sign that market is really paying attention to what, these companies are delivering.
Yeah, and it seems quite divergent, doesn't it, between individual names, Justina. Thanks so much. Bloomberg's Justina Lee with the latest on the markets. And for more market analysis, check out MLIV Go. That's the function to use on your Bloomberg terminal. That's where you find the Markets Live blog. This is Bloomberg.
Welcome to the world of decentralized finance.
I'm going to take a look right here at regulation.
We are seeing digital currencies under some pressure.
Bloomberg's covering all things crypto. The people.
I want to have some of my money outside of the sovereign.
The transactions.
It all comes down to the details here.
And the technology.
How does that affect disruptors like you?
What happens to everything that you're investing in when the last Bitcoin is mined?
Bloomberg Crypto, Tuesdays.
A lot of the satellites have propulsion systems. They can kind of move to get out of the way of each other or change their orbit a little bit. It's a service that you guys offer to help these companies know how to maneuver their machines.
Yeah, we offer a collision avoidance service. It's a subscription service. We'll send you an alert up to 7 days in advance if your satellite's going to come dangerously close to a piece of debris or another satellite.
Companies have been doing that for decades, moving satellites around, but it's sort of like a harder problem now.
The risk of a collision is a lot higher now, just because we've installed so much more hardware into space. You have a big collision, it creates a cloud of debris, and now all the other satellites are flying through this whizzing mess of debris. As we add all of the new satellites into space, the risks of the collision, the likelihood of the collision is going up.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. Power, policy, politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect. How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons with Katie Greifeld in New York and Anna Edwards in London. Matt Miller is off today. Now keeping you up to date with news from around the world, here's the first word. In western India, at least 130 people were killed when a suspension bridge collapsed. The disaster happened in Prime Minister Narendra Modi's home state, Gujarat. The colonial-era bridge had been reopened last week after renovations. And in South Korea, the government has opened an investigation into one of the country's deadliest incidents in years. At least 154 people were killed when a crowd squeezed into a narrow alley during Halloween festivities in Seoul. Reports are that some people began to fall, causing others to tumble and pile onto one another. Today, there's a showdown at the U.S. Supreme Court over affirmative action. Justices will hear arguments on admissions policies at Harvard and the University of North Carolina. The schools are battling an interest group that wants to overturn precedents that let colleges consider race when they choose students. And Elon Musk is preparing for a round of job cuts at Twitter. Bloomberg has learned that the company's new owner has asked managers to draw up lists of team members who could be let go. Musk has denied reports that he plans to get rid of 75% of Twitter's 7,500 employees. So, Katie, it becomes a question of just how many people he does intend to let go and in what departments he would like to let them go from. We understand from Washington Post reporting over the weekend that maybe the ultimate number could be something more like 50%, which is still potentially thousands of Twitter employees.
Big time. And I mean, a lot of this is coming from Musk himself. We've gotten some clues from his tweets. In recent weeks, he had said that he wants to focus on the core product. You would think that includes software engineering and the like, but it's a bit of a moving target at this point, Anna. All we can do is really wait.
Yeah, absolutely. So the job cuts is one part of the story. What he wants to do with crypto, Kaylee, is interesting. We'll talk more about that later on in the program. But also how advertisers respond to the new ownership. We heard from GM, of course, ahead of the weekend, and they have an interesting stance here because, of course, Kaylee, you know, now we've got Musk running the show, and he, of course, runs Tesla, and so they're rethinking, and they're very close to him, I suppose, in that sense, in rival parts of the autos sector. But it'll be interesting to see how lots of businesses decide to manage this.
Well, and how regulators do as well. We've seen increasing scrutiny on social media players, especially the ownership of them. And after the attack on Paul Pelosi, the Speaker of the House, Nancy Pelosi's husband, several days ago, you have seen voices in D.C. talking about the need to police these social media companies in a better way when it comes to misinformation and conspiracy theories and the like. So the regulatory scrutiny, definitely an angle to watch. There's so many different parts of this story, and of course, we'll continue to keep track of all of it.
Yeah, a piece of corporate news with perhaps global implications. We will certainly keep on across that story. Coming up, Amanda Agati joins us, PNC Asset Management Group CIO. We'll focus in on the Fed. That's the highlight midweek, of course. What does she expect to see from the Fed itself? What does she make of the step-down narrative that the markets are dealing with right now? This is Bloomberg.
fascinating entrepreneurs because you all started really young. What did you learn? Did you always think that you'd be an entrepreneur?
Probably, yes. I think, which is a bit sad,
From
isn't it?
age, what, 5?
Well,
6?
maybe, I'm not sure. I come from a family of entrepreneurs, so even though I probably couldn't spell the word and still can't occasionally, it's sort of in my blood. But it's really fun starting a business. And fun growing a business. I feel it's a real privilege. And I started my business officially at 18, but I think I knew I wanted to do it very differently from about 15. But I'm sure it's, if you're surrounded by it, it feels very natural. So yes, it's fun.
And it started how? You started by you went to Florence. It was in Italy, and you started handbags.
Yeah, so I knew I was actually given a handbag by my mother when I was about 16, one of her old handbags, and I remember how it made me feel, and I think fashion is fascinating for the mood-changing, the confidence-boosting aspects, of the sort of tribal aspects of what fashion does. And so I went at 18 to Florence, knowing that was the home of leather goods, which is what interested me. I just wanted to learn, actually, and be surrounded by craftsmen who, making things is important, and that's going to be very interesting, I think, over the next sort of 10 years. I think the onshoring of craft and manufacturing is going to be fascinating, actually. I watched the offshoring. I literally saw it, and I think we're going to be seeing that coming back to local. We have to. When we're all looking at our objectives in terms of carbon, proximity is going to be key.
Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology.
Welcome to Bloomberg Crypto.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. A crucial time for stock traders. 4 major events in the next 7 days could shape the market's outlook for the rest of the year. We will get analysis. A dramatic comeback in Brazil. Left-wing politician Luiz Inácio Lula da Silva is re-elected president 3 years after he was in jail on corruption charges. And the price of wheat soars after Russia pulls out of a deal allowing Ukrainian exports. Meanwhile, Ukraine says Russia has launched a massive wave of missile attacks. I'm Anna Edwards in London with Katie Greifeld and Kaylee Lyons in New York. Matt Miller is off today. And Katie, US futures point a little bit lower. The gains of last week, a really strong week for US stocks, of course. They seem a bit of a memory as we get ourselves ready for a busy week ahead.
Oh, big time. A distant memory. The mood music, not great in U.S. pre-market trading. We're looking at the S&P 500. Futures down about 0.5%. NASDAQ futures down a little bit more to the tune of about 0.7%. This is the opposite dynamic of what we saw on Friday when big tech was really leading those gains. Maybe a bit of a breather as we count down to the big week ahead. All of this coming as the bond market continues to sell off. You're looking at 10-year Treasury yields up about 5 basis points or so, firmly above 4%. And of course, Kelly, checking in on wheat after Russia did pull out of that export pact, about 6.5% higher in an already stressed out global food supply chain.
Yeah, that's definitely something we need to keep an eye on. Now, Katie, as you said, the mood music isn't great, and a lot of that has to do with the drag created by big tech, which are broadly lower in pre-market trading when it comes to those names, including Tesla down a little more than 1%. You have Amazon down about 0.9 as well, and Apple, after a big more than 7% move to the upside on Friday after its earnings report, is giving back some of that gain, down about 0.5%. And of course, it's not just North America we have to pay attention to today. We have to pay attention to South America as well, specifically Brazil, after the results from the presidential election yesterday showed that Lula has won the election, topping Bolsonaro, although he has not yet conceded. And maybe some of the risk around that, what ultimately is going to happen, is what is dragging on Brazilian assets today. I'm measuring that in pre-market trading by taking a look at the iShares MSCI Brazil ETF. It is down about 5.25%. So definitely an asset class and really just a country to keep an eye on today and the days ahead as well, Anna.
Yeah, absolutely. We'll keep an eye on what's going on in Brazilian assets as a result. This is what's happening or not happening on European stocks right now. This Monday, we find ourselves entirely flat on the Stoxx 600. But there are two divergent stories here. There's one, energy names are moving lower. This after we got disappointing data out of China. That's weighing on the oil price, and as a result, energy names go lower. On the other side, the banking sector goes higher, and there were a couple of reasons for that. We've got NatWest Group up by just over 3%. A lot of talk over the weekend in the newspapers in the UK about whether the government will decide decide or not on the 17th of November in its autumn statement to go after banks for more tax raising. And it seems that the most recent thinking is that it might not. And so NatWest Group and others in the sector rally. Credit Suisse up by 2.7%. We've got a bit of a detail. Of course, we saw a real fall in this share price on Thursday, some recovery on Friday, and it's still trying to make its way back up, of course. We've heard some more detail about the capital raise there, the number of institutions that are being asked if they want to participate in it. And we've also got the euro dollar in here. There's dollar strength is the broad theme this Monday morning, but euro weakness also part of it. And we're looking actually at some much better data coming out of the eurozone when it comes to growth numbers. Certainly that was the case out of Germany and some other parts of the eurozone and Italy just this morning. And we're looking ahead in half an hour's time, Casey, we're going to get inflation data. Will it come in at 10.3%, just underlining the difficult choices ahead for the ECB?
Definitely a lot to keep an eye on, even just today. But one of the big headlines this week is going to be the Fed, expected to raise interest rates by 75 basis points when it meets this Wednesday. This week's MLive poll survey asked investors how they're trading ahead of the meeting.
Right now, all central banks are playing tough and talking tough.
Investors are obviously skittish as the Fed pulls away the punch bowl of easy money, and that's going to lead to a lot of mispricing and uncertainty.
We're not only in fiscal dominance in this game of chicken between Treasury and central bank, we're in what the folks at the Bank of International Settlement call a debt trap.
It's really a Fed-driven downturn that we're seeing, and it's going to take the Fed to correct it.
Maybe the Fed could signal a move towards a smaller increments of rate hikes next week after they meet.
The labor market is still strong, but it requires a Fed that has a lot more skill and a lot more luck.
That means you need to see higher unemployment. And if that's the goal, they are failing miserably.
I think the bond vigilantes are back.
Joining us now is Amanda Agati. She is CIO at PNC Asset Management Group. Anna, or rather Amanda, it's great to have you with us this early in the morning. If the Fed delivers 75 basis points on Wednesday, it would be the fourth straight hike of that magnitude. Then if you look at market expectations, it's expected to dial back from there. But what's your expectation? Will Wednesday be peak hawkishness for this Federal Reserve?
Well, let's hope so. I think the markets and the economy can only take about as much as we have in terms of hawkishness right now here. We're definitely in the camp that we're going to get 75 basis points. Market certainly expecting that. I really continue to believe it's not necessarily about each individual Fed meeting and much more about where the terminal rate ends. Based on the current dot plot, we're looking at about 4.6%. for that terminal rate. There's never been a scenario where the Fed has been tightening through history and reached 4.6% and not tipped the economy into recession. So that's really the data point that I'm much more focused on. Are they going to revise that? And what does guidance tell us about the path forward for rates from here?
Okay, so Amanda, where would you put the likelihood of a recession at this point? And is that accurately reflected in markets?
I do think that it is to some degree accurately reflected in markets. We think we're based on where financial conditions are, where interest rates are today, that we're trading at roughly a fair value range on the S&P 500. We've been bouncing around the 15 to 17 times forward PE range. Our expectation for a recession is basically a coin toss at this point. It's about 50-50 for next year, but it really comes back to the Fed being in the driver's seat. My view is that they put a really aggressive outer bound there in terms of that terminal rate, and that, between now and then we start to get a little bit of relief from some of the perfect storm macro headwinds that continue to swirl. So the Fed ultimately doesn't have to fight this inflation battle alone. The thing that really, I think, keeps me up at night is that the Fed is being forced to fight this battle, but there are a number of other forces in the backdrop that are not going to respond to higher interest rates or a tapering of the balance sheet. So the Fed needs a little bit of help in fighting this battle.
Right, the Fed can't fix supply side problems, Amanda, and also their mechanism is monetary policy. There's a fiscal policy question as well, especially with the midterms coming up next Tuesday. How are you thinking about political risk around that event and ultimately what the composition of Congress could mean for these markets?
So at the end of the day, there's a lot of things to keep investors up at night over, but we actually think this midterm election cycle is not one of them. I think when you look at all the different guideposts that might give us some sense of how the election is going to turn out, when you look at polling data, economic data, even market performance itself, all of those guideposts are suggesting a change in control. It doesn't necessarily mean it's a Republican sweep, but certainly a challenge of the status quo. And at the end of the day, markets really prefer gridlock because it can't really drive meaningful negative policy surprises in one direction or the other. So we'll take it in terms of a little bit less political volatility so the markets and the economy can focus on all of the other macro headwinds.
Okay, yeah, interesting to think about what the market's like here, Amanda. In terms of what you're seeing on Recession Watch, you talked there about it being a 50-50 call right now. We're getting interesting clues from the bond market. Some of that yield curve inversion has suggested to some that we're seeing clues that a recession is coming. Why are you not quite so convinced by those signals?
Well, the yield curve is definitely an important predictor in terms of the countdown to a recession, and it's been giving all kinds of mixed signals over the course of this year. The 2-year to 10-year portion of the curve has been handily in negative or inverted territory. I think at this point it's now the most inverted since 2000. So you would naturally expect to say, all right, well, a steep recession is certainly on the way, but it was only until last week where we saw the 3-month to 10-year portion of the curve invert. And so I think there's some doubt as to whether this is a false positive signal or whether this is going to be the shortest business cycle in U.S. history. I think it really comes back to the Fed being in the driver's seat. The Fed doesn't go all the way to 4.6% or potentially higher, depending on what they do with the dot plot. I think the odds of a soft landing can increase, but we just don't have great clarity on how far and how fast they're going to go from here.
And what have you made of the earnings story so far then, Amanda? A lot of people trying to explain the rally last week by looking at some of the detail of those earnings stories, all the broad strokes, and saying, you know, this is what it told us. Others saying, look, it is just about the Fed, and it's about that step down narrative. We used to call that the pivot, now we call it step down, apparently, and how that is playing out in markets. What do you think is the role of earnings in that context?
Well, I'm an equity girl at heart, so I'm always fixated on the fundamentals and earnings season. It's always one of the 4 most wonderful times of the year for me. That being said, I think it's almost irrelevant in the context of what the Fed is or isn't going to do. I wouldn't say that earnings season has been bad per se. I'd maybe give it more of an optimistic spin and say it was mediocre at best. We definitely set a much lower bar for both revenue expectations and also earnings expectations. So far, companies are sort of beating, or by a narrow margin, kind of beating on both of those metrics, those lowered expectations. So it hasn't been great, but if I zoom out and say that's just one quarter, what does the rest of the year look like? What does 2023 look like? We're still hanging in there. We're looking at about 7% earnings growth for this year, followed by 8% next year. So for all the talk about an economic recession, no earnings recession just yet.
No earnings recession just yet. Amanda, thank you so much for joining us. Amanda Agassi, CIO at PNC Asset Management Group. No doubt we will have you back on the program soon. Coming up on this program, though, today, putting more crypto into Twitter, perhaps. We will discuss some of the potential changes from Elon Musk as he takes charge of the social media platform. That conversation next. This is Bloomberg.
Now they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible, to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons with Katie Greifeld in New York and Anna Edwards in London. Matt Miller is off today. Well, after months of dramatic back and forth, Elon Musk has taken control of Twitter. And crypto Twitter is bracing for how the billionaire will put his stamp on the social media platform, with the takeover opening up possibilities for blockchain and other features. Alex Webb of Bloomberg Quick Take joins us now for more. So, Alex, before we talk about how crypto on Twitter could change under the Musk regime, what is crypto on Twitter like now? What is the stance?
Well, there's not really much payment that you can do on Twitter at the moment, but there are various sort of NFT applications. You can have verified NFT for your profile picture, for instance. But the real opportunity I think they're looking at is how to actually integrate aspects of cryptocurrency world of tokens more deeply into the app, and particularly the payments layer.
And Alex, it's kind of impossible to know what Elon Musk is thinking. I'm not going to pretend to read his mind. We don't know his current feelings towards crypto, but we do know that crypto exchange Binance is an equity investor in this Twitter deal. What could that mean for the platform?
So it's been reported that Binance is actually building, offering a team to Twitter to help it integrate more crypto products into the platform. And the part where this starts to get interesting is we've seen Elon Musk tweet about the prospect of turning Twitter into a super app, something like Tencent. Now, the one thing that you really need to create a super app is a payments layer, is something which lets you go onto the platform and clearly pay for all the different services that they might hope to have on there. That's how WeChat works. Now, if somehow there is a world where Binance helps them build that payments layer into the platform, then it might prove to be a springboard into that super app world. Now, this is all speculation, of course, ifs, buts, maybes, could be's, possiblies, but that does seem like it might tie up.
A lot of possibles. Meanwhile, what's the broader story around Twitter as Elon Musk takes control? We hear a lot of talk about job cuts, of course. We've seen a lot of job cuts elsewhere being talked about in the tech sector, but this has this very special dynamic. He seems to want to do a whole lot more with a whole lot less people, fewer people.
But not least because he's got to find something in the order of $1.5 billion to service his debt obligations at the company per year. So at the moment, Twitter is expected to have something like $800 million in negative free cash flow this year. He needs to find a whole bunch more of that in order to keep his debt investors happy. Now, clearly, cutting headcount is the fastest way to find some capital. You also need, to your point, to find some growth in order to generate the rest of it. And whether you can do that with less is a different question. The one caveat, of course, is there's sort of a consensus among vast tracts of Silicon Valley that actually Twitter was overstaffed, given what it does. It had very low average revenue, not just per user, but average revenue per employee. And so if it can find a way of working more efficiently, then perhaps then there is an upside.
All right, Alex Webb of Bloomberg Quick Take, thank you so much. And if you want more of the crypto conversation, make sure to tune into Bloomberg Crypto on Tuesday. That's tomorrow at 1 p.m. New York time, 5 p.m. in London. Our weekly show covers the people, transactions, and technology shaping the world of decentralized finance, so don't miss it. This is Bloomberg.
hydrogen has a very special place in the universe. It's the first element on the periodic table. It is the most abundant element in the universe. And when clean energy advocates think about what can we find which would be as easy to use as fossil fuels, they think about hydrogen. The fuel that will, when burned, only produce water.
We like to imagine that if we just built enough of these and these, we could ditch fossil fuels and save the planet. Unfortunately, it's not that simple. There are some things where you just need a good old-fashioned combustible fuel. Now, startups around the world are betting that hydrogen can become the fuel of the 21st century.
Part of what I love about business is you get to build things from nothing.
I don't have any investors. All this is all money in. This is me just building it.
It's pretty much full-service shadow banking with nobody in charge.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Katie Greifeld and Kaylee Lines in New York. CS Venkatakrishnan, the CEO of Barclays, known as Venkat, of course, in financial circles, took over the top job a year ago after the abrupt departure of former CEO Jez Staley. Now he's leading Barclays through a war in Ukraine, rampant inflation, and aggressive central bank tightening. In his first TV interview since taking the helm, Venkat spoke exclusively to Francine Lacroix on Bloomberg's Front Row.
I think the UK economy has had a lot of support during COVID, and obviously the UK has been growing more slowly than it should. But the financial services industry, which is a large part of the UK, is very competitive. But it's not the only one. Health sciences, even technology and parts of technology, fintech, are very, very bright stars in the UK. So the UK has a lot going for it, and I don't think you will see that kind of environment. I think what I'm hoping you see is what people will call a soft landing and a shallow recession, helped by the initial conditions. And so what you might see is an increase in unemployment. You might see some credit weakness among customers, but it won't be so bad that you see distress in society. However, it has to be managed carefully, and it has to be managed aggressively with a balancing of the budget, and that's what the Prime Minister has said in the last couple of days.
Are you expecting a housing crash?
I doubt it.
Talk to me a little bit about the last 6 weeks. So you mentioned the guilt. I mean, was there a moment where you were in the office thinking, like, as Barclays, you're one of course, the players in selling and buying gilts, with the margin calls coming in and saying, like, I don't know what happens in the next 2 hours.
So first of all, I think that the volatility was managed extremely well by the very effective, targeted, and time-bound actions of the Bank of England. So I think buying gilts, buying inflation-linked gilts, and then the repo facility that they put in, working with the banking system, all helped ease the pressure in the crisis. And you've got 10-year gilt yields now back below where they were at the day of the mini budget on the 23rd of September. As for us, I mean, we are large in the gilts market. What was important for us, as we saw it, was this was not a solvency issue at all for the pension system. It was a liquidity issue. And it was a liquidity issue because what was a very important feature of the UK pension system, which, by the way, I think is a good feature of the pension system, which is a matching of assets and liabilities, which employed leverage, created a liquidity problem. So a liquidity problem had to be managed. And the liquidity problem was managed by the government intervention or the Bank of England intervention, the repo facility, which allows people to borrow against assets rather than sell them, and by slowly releasing the pressure. And, so far, so good.
Do you think that will change, actually, regulations surrounding pensions in the UK?
So I don't know the answer, but I think what is important is that the UK pension system in aggregate is very well funded. It's about 125-130% funded ratio, which is extraordinarily good, which gives it a good starting point from which to manage to a less leveraged future.
Is liquidity the biggest concern for banks right now? I mean, we're again hearing, the U.S. Treasury Secretary having to do things maybe to put a bit of extra liquidity or to pad it out in the Treasury market.
So bank liquidity, I don't think, is an issue. We've had liquidity regimes. Funding models are much, much more robust than they were in the financial crisis. I think part of what people are worried about and what they saw in the gilt market was the liquidity in underlying trading, which is that these markets are not deep with small bid offers in large sizes of trades as they used to be 15 years ago. And I think part of it, our banks are more prudent in managing their risk.
That was CS Venkatakrishnan, CEO of Barclays, speaking with Francine Lacqua on Bloomberg's Front Row. All right, now let's take a look at what is coming up for the rest of this week. OPEC will be launching its World Oil Outlook report later on today. Then on Wednesday, it is the Fed rate decision, 75 basis points, what we're expecting. Then the BOE's rate decision will come up on Thursday. And on Friday, we will get the U.S. jobs report. So very, very busy, Anna. But there are also events taking place right now today that we want to keep tabs on.
Absolutely, yeah. The Bank of England in focus later this week on monetary policy. Today it's in focus for different reasons. Lizzie Burden is outside the Bank of England for us. And Lizzie, what has happened at the Bank of England today?
Well, Anna, as you can see, the Just Stop Oil protest has reached Threadneedle Street. You can see the orange paint on the front door of the Bank of England, and it's a coordinated attack. It's also on the Home Office, the MI5 building, and the News UK building, which of course is home to the Times, the Sunday Times, Dow Jones, the Wall Street Journal newspapers. But really the message from the protesters today is that the big banks, the 60 biggest banks, have funded the fossil fuel industry to the tune of $3.8 trillion since 2016, they say, and the Bank of England specifically hasn't done enough to regulate them. That's their argument. That's what they're trying to draw attention to.
And Lizzie, quickly, is this likely to have any impact policy-wise?
Well, the climate is very much in focus at the moment in the UK because, of course, Rishi Sunak is saying he's not going to attend the COP conference because of more pressing domestic issues at home, yet Boris Johnson is attending, so pressure on him. But also, he's demoted two climate ministers. His COP minister isn't attending cabinet. But really, as you hint, Anna, perhaps today was not the day to be doing this to the Bank of England when we've got a decision on Thursday.
Lizzie, thanks very much. Bloomberg's Lizzie Burden reporting from the Bank of England on today's climate activism. She'll also be there on Thursday to talk about monetary policy, of course. That is it for the early edition. Surveillance is up ahead. This is Bloomberg.
Apple's delaying its next major iPad software update, iPadOS 16, by about a month from September to October. Apple made the decision for a number of reasons, including a still buggy Stage Manager multitasking interface and in order to link the launch closer to the more similar macOS Ventura. Still, it's an unusual move. Since shifting the launches to the fall in 2011, Apple has released its new iPhone and iPad software updates simultaneously each year around September. By staggering the releases, users may find some issues around compatibility with cross-device features like retracting and editing messages in iMessage, the new shared iCloud photo library, and the new feature for transferring FaceTime calls between iPhones and iPads. It will also make it a bit harder for developers to launch apps that run on both the iPad and iPhone that require new APIs and features found across iPadOS 16 and iOS 16. Regardless, it was still, of course, the right move. Stage Manager on iPadOS 16 is still quite buggy. I don't find it particularly intuitive, and it's not compatible with most iPads and many third-party apps on the App Store. The feature clearly needs some more polish. And complaints from consumers about Stage Manager will now no longer probably overshadow the earlier launch of the iPhone 14.
Multi-trillion-dollar industry. There's a lot of ground to cover.
Prepare for an economic hurricane.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Today on Bloomberg.
Just another data point that people have to absorb to try and understand this narrative.
The source of the negative surprises this quarter has been, in fact, weaker margins than was anticipated.
The market is consistently underestimating the level of inflation by anywhere from 50 to 150 basis points.
The Fed has been leading the most recent push higher in global rates.
Everybody wants to channel their inner Volcker. You better be careful you get what you wish for in a levered system.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
TK takes Halloween really seriously.
Yes, he
does. Which is why he took the day off. It's not the first time, you know.
Yeah,
he spends the morning dressing up. It's TK's thing. Live from New York City this morning. Good morning to you. This is Bloomberg Surveillance on TV and radio alongside Lisa Abramowitz. I'm Jonathan Farrow. CPI in Europe out just seconds ago, coming in really, really hot. We'll talk about the next central bank decisions a little bit later this week. But Bramo, 10.7% on CPI in a Eurozone this morning.
And this really highlights the tension because the third quarter GDP grew more than estimated, right? More than expected at 0.2% versus the estimate of 0.1%. So how much are we looking at this idea of consumer prices rising faster than expected, but the economy is still hanging in, basically prodding the central banks to keep raising rates?
The economy hanging in for now. The PMIs in Europe last week in the 40s, 75 basis point interest rate hike. It's not looking great for some of these central banks really struggling at the moment to maintain financial stability, to try and get inflation down and support growth simultaneously.
So Mike Wilson actually has talked about peak inflation, that perhaps people are getting it wrong this time, as wrong as they did in 2021. But on the other side, that actually inflation is going to drop much more quickly because of all the tightening that hasn't worked its way into the system. I wonder how much we start to hear that. I wonder how much the Fed starts to confirm that belief. And then what does the market do, right? They take that and run with it, and then they have to backtrack. Or do they understand? Do market participants understand this means a slower growth, slower bleed, slower margins in some of the companies that we see reporting?
The biggest challenge for the Fed this Wednesday is how do you communicate some form of step down that you're open to dropping, say, from 75 to 50 to 25 without triggering a premature easing of financial conditions, which is arguably what we've seen take place over the last week.
Well, and this is the real key here. How do they communicate? There is a lot of pain, and how does it get confirmed by earnings that have yet not capitulated, right? People don't think that they've really expressed the full pain that will be coming next year in the first quarter. So if you haven't seen the full pain yet, it's going to be hard for the Fed to really sell that without causing some sort of rally in the markets.
Can I just say that last week was truly impressive to see Alphabet, Amazon, Microsoft, Meta absolutely hammered, and the equal weight rally every single day last week on the S&P. And the S&P 500, the market cap weighted index, up by what, 4% on the week?
So bear with me. This is somewhat complicated, but this is what I was trying to think about over the weekend. When does it not become good news for the Fed to pause or do a step down? When does it become bad news for rates to not go higher because the economy is not doing well? Right now, the rest of the market treated that softer earnings were a good thing for for this Federal Reserve looking for more weakness, for more pain? At what point will it just be a bad thing? And at that point, is that when we see the real capitulation?
Futures right now negative about 0.5% on the S&P. Let's whip through the price action for you, starting with equities, then moving to bonds. In the bond market, 12 consecutive weeks of yields climbing on a 10-year until last week. Last week, yields lower, much, much lower. On a 10-year right now, higher by 5 basis points, just north of 4%, 4.06% on a 10-year. Euro dollar down by 1/3 off the back of some pretty hot CPI. Got a decent steer that we'd get this off the back of the German inflation numbers, the French, the Italian at the end of last week, but still to see it there, very close to an 11 handle on a Eurozone figure for the month of October year over year. Euro dollar right now, Bramo, 99.37.
10.7%. It's a pretty shocking number considering the no-inflation regime that we had for so long. This week ahead is going to be massive for a whole host of reasons. We get a number of Fed decisions, or I should say central bank decisions, the Fed decision being front end of them all. But also the Reserve Bank of Australia tomorrow gives out their policy decision. The FOMC rate decision will be the key one on Wednesday. What do they signal beyond the step down, the threshold that it takes? Where is their optimism about the economy? And then the Bank of England decision on Thursday will be interesting as well. And this comes as two-year yields around the world continue to climb and hover near the highest levels since the financial crisis. We also get a slew of economic data. The U.S. employment report on Friday for the month of October is the key one. But before that, we also get the JOLTS data, and that comes tomorrow. I'm very interested in job openings. How much do they continue to plummet because companies are sort of soft, not hiring, right? They're sort of trying to look, John, for some kind of way to pare back without cutting jobs because they don't know how hard it's going to be to hire people.
Well, freezing is the new firing, right?
Yeah.
You can't fire what you couldn't hire, and that's been a story of the last 12 months. Job openings is going to be fascinating just to see how much that comes in and to see whether we do any damage to the labour market on Friday in the unemployment report. Ultimately, the Fed's goal, what is it? To soften demand in the labour market. Have we seen any sign of that whatsoever in the official data?
Not in the official data, right? Not in the unemployment rate, not when it comes to initial jobless claims, but in the JOLTS data, yes. And in the earnings reports, yes. And that brings me to the third thing that I'm really watching this week, which is almost a third of the S&P 500. About 160 companies are going to be reporting earnings this week, including Pfizer, Uber, Starbucks, Airbnb, Marriott, Kellogg, Hershey, a whole host of them, at a time where the consumer really is the question. How long can they hang in there given the savings that they have, but also the inflation that they're feeling really reduce their buying power?
And let's kick off the program in the Trading Week with Brian Weinstein, the head of global fixed income at Morgan Stanley Investment Management. Brian, fantastic to catch up with you, sir. Walk us through Wednesday and what you and the team are looking for at this Fed meeting.
So you guys did a great job setting it up for me. It's going to be a very interesting day. I mean, the Fed has a good old-fashioned friend to lean back on called math, right? The Fed has raised rates 75 basis points now in so many meetings, getting up to this 4% level so quickly, and they have to slow down, and the markets want to like it. But then they have to use, I think, some other mathematical tools at their disposal to remind people that the slowdown hasn't started yet, right? Mortgage rates at 6 or 7% is a big deal. Cash and fixed income as a draw of capital, right? As an asset class you can invest in should slow down the economy. And so I think the Fed is going to have to step down to a lower pace, but at the same time remind people that they've done a lot of work and that they still have more to do.
Step down to a lower pace, Brian. Does that mean that the end point will be lower, or does it mean that potentially it could be even higher because it isn't going to cause the market to break in short order?
Yeah, I think it means it could be higher. I think what they're trying to avoid is going 75 at the next 3 meetings and then easing again starting in, say, March or so of next year. They don't want to do that. They don't want to break anything. What the Fed always wants is to see what have their actions done, and what impact will it have. And it happens at such a lag, and CPI being the worst of them all, right, in how slowly it moves. They want to see if end user demand is slowing, and we're starting to see it in earnings. We're starting to see it in anecdotes. So I think all they're doing is buying time so that they can raise more, but do it more slowly.
Goldman Sachs just upped their expectations for the end of the Fed funds rates to 5%. How much have you increased your expectation for the end point over the past few months, and where do you see it potentially going if perhaps they do this step down and it does allow the economy to keep going without some sort of sudden stop?
Yeah, listen, it is scary to look at the inflation numbers, right? They do continue to surprise to the upside, despite the idea that on the other side of this, as Mike Wilson has told us, is a quick slowdown. So we've been steadfast in that kind of 4.5% to 5% range. That's what the Fed told us. We have no reason to believe that that's wrong, and we do believe that inflation will start to slow down, that it is lagging, and that it will take longer than we want. So again, I've been a big believer that anytime you get 2s near 5% and 10s above 4, 4.25%. they're good buys, because I do think the flat curve is telling you that they don't have to go that much higher than here.
So if that's the case, Brian, is one of your biggest conviction calls at this point just go into 10-year treasuries, go into the longer dated curve, whether it's IG, whether it's treasuries, and just hang on?
I like it. I mean, I don't think you're going to wake up one day and have 10-year notes back at 2%. I don't think that's the game here. I do think earning that income in high-quality assets. By the way, you can do it in agency mortgages, might be the cheapest one. Investment-grade credit, high-grade municipals, treasuries are okay too. Earning that income is, I think, a very powerful ally in a world of high volatility and uncertainty if inflation is falling, because you'll wake up one day wanting to own that stuff, and again, it won't be 2%, but it might be back to 3.25%, 3.5%, and so those are great cash flows to own. We do like them, and we continue to add as rates go higher.
We're less than 2 weeks to the U.S. election, and this is something that people are watching, not only with respect to the economic policy of Washington, D.C., but also the political pressure on the Federal Reserve. How does that factor into your bullish call on 10-year treasuries? What would you think, or how much would you move away from that call if, say, there was political pressure put on Fed Chair Jay Powell to stop hiking rates and to be a lot less aggressive?
You know, we've been debating this, I think, since their actions in 08, maybe even before, about central banks and their autonomy and whether or not that's under pressure. And it has been, right? It continues to be. And yes, if you do see a government that wants to go after the Fed and stop them from doing what they need to do, that does change things, right? It could risk much higher inflation rates. It could risk losing control of the dollar as reserve currency. But those are not things that we're investing on right here. It's easy to talk about going after the Fed. It's much more difficult to actually do it. They've done a pretty solid job. They've made their mistakes. They're not perfect, but I think they've corrected by raising rates a lot, and we're watching it, but not terribly concerned at the moment.
Brian, awesome to catch up, buddy, as always. Brian Weinstein there of Morgan Stanley Investment Management. What I've seen a lot of over the last couple of days is not just the talk of a step down, but maybe of a stretch. Saw that from Evercore a little bit earlier this morning. You add in an extra 25 basis point hike. We've seen that from Evercore, seen that also from Goldman Sachs. So what you're communicating is, sure, we'll basically step down in the pace of rate hikes, but we'll throw another one in there anyway because we're going to stay tighter for longer.
Well, and that's really the key issue, right? Could they potentially talk about a step down and still communicate a hawkish message to the U.S. Markets, right? How do they say, basically, look, you're going to like the step down, you're not going to like what comes after, because we're going to keep going, perhaps at a slower pace?
Can this not be the step down show for the rest of this week? Isn't it driving you? It's been driving me nuts for the last couple of weeks already. Let's get to a serious story. Russia suspended the Ukraine grain deal. We understand that vessels are still leaving, loaded up with crops, but this is something to watch for the next couple of days for sure.
This is actually really painful, and I was watching some of the footage, and I was reading some of the stories, but this is grain that supplies significant portions of East Africa, right? So there are entire nations that could go hungry if the grain doesn't get there, and you're seeing wheat prices surge. How much does this really signal a breakdown with respect to Russia from the rest of the world, and how much they're willing to comply with trying to ameliorate world hunger on the basis of getting more leverage?
On that story, we'll catch up with AMH down in Washington, D.C. in just a moment. Looking forward to doing so. In the next hour, James Athey, Investment Director over at Aberdeen, is going to join us on the Federal Reserve step down and the Bank of England and all that good stuff later this week. Live from New York City with equity futures down about 0.5% on the S&P. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. In Brazil, it's a dramatic comeback for former President Luiz Inácio Lula da Silva. The left-wing politician has won the presidential election, narrowly defeating incumbent Jair Bolsonaro. 3 years ago, Lula was in a jail cell on corruption charges. Bolsonaro has neither conceded the race nor commented on the results. His reaction will be closely watched by investors. In Ukraine, the government says Russia launched a massive wave of missile strikes across the country. Part of the capital, Kyiv, was left without power and electricity after the missile strike. The attacks came after Russia pulled out of a deal that allowed millions of tons of Ukrainian grain to be exported. Russia withdrew after accusing Ukraine of attacking its warships. In South Korea, the government has opened an investigation into one of the country's deadliest incidents in years. At least 154 people were killed when a crowd squeezed into a narrow alley during Halloween festivities. Reports are that some people began to fall, causing others to tumble and pile upon one another.
In western India, at least 130 people were killed when a suspension bridge collapsed. The disaster happened in Prime Minister Narendra Modi's home estate, Gujarat. Now, the colonial-era bridge had been reopened last week after renovations. Economists at Goldman Sachs now see the Federal Reserve raising interest rates to 5% in March. That's higher than their previous estimate. Goldman's new forecast includes another 75 basis point hike when Fed policymakers meet this week. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
These floating flowers are made of 92,000 solar panels. Laid on the surface of a reservoir, they can generate 41 megawatts, which is enough to power 20,000 homes. It's one of the biggest floating solar plants in the world. Floating solar arrays have been gaining traction in Asia, including countries like Singapore and Thailand. Floating projects typically benefit from an easier connection to the power grid. They can also restrict algae blooms while keeping the solar panels cool. This one in particular has helped the local economy. When the power plant was first proposed, residents were given the chance to invest. Some locals were also offered jobs during construction. In fact, it was the community that requested the panels to be shaped as flowers to look more appealing. South Korea still relies heavily on imported fossil fuels, but will need to change that to reach its goal of becoming carbon neutral by 2050. Solar plants like this one may help the country reach its net zero goals.
Lots happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights
We think that's the next secular shift.
from businesses most influential and instrumental.
It's knocking it out of the ballpark.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio. Welcome to the world of decentralized finance. Bloomberg's covering all things crypto, the people, the transactions, and the technology. Bloomberg Crypto, Tuesdays. Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become chief future officers. Duke Energy has an ambitious plan to transition to clean energy, and new CFO Brian Savoy is ready to lead the charge.
We're going to invest $145 billion over a decade. There's a lot going on, but I wouldn't have it any other way.
Watch Chief Future Officer Wednesday on Bloomberg. The markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. The market Markets expect another rate hike.
Investors obviously skittish.
What the Fed do on November 2nd is key to everything.
But where will the Fed go from there?
No sign it is ready to stop tightening.
Everybody talking about a step down.
They're going to wimp out and they're going to blink.
Trust Bloomberg for the fastest coverage and exclusive analysis.
Do we want this Fed to force a recession?
The Fed's going to torpedo momentum.
In markets like this, everyone's a long-term investor.
Bloomberg Surveillance. The Fed decides. Wednesday on Bloomberg, your global business authority.
I think the Democrats are going to get a rude awakening on November 8th that, high inflation, high crime, open borders, not what the American public wants.
Don't punish the people who are fixing your problems, and don't reward the people who are trying to exploit the problems for their own political power. That's really the difference right now. We're engaged in the hard work of bringing our country forward. The other side's working on their own power.
1 week to go. Senator Rick Scott of Florida on ABC and Congressman Sean Maloney on New York on CBS. From New York City this morning. Good morning. Here's the state of the market for you. Equity futures look a little something like this on the S&P. Futures negative 0.5%. Call it down 6. Yields higher by about 4 or 5 basis points, just north of 4%. Whole host of banks, Evercore, the likes of Goldman, talking up maybe an extra 25 basis point hike somewhere in our future in 2023. Euro dollar negative 1/3%, 99.34. I can tell you a little bit earlier this morning, CPI out of the Eurozone, upside surprise, 10.7%. The previous number, 10%. The survey, the median estimate, 10.3. And the ECB last week, let me tell you, setting up a flip-flopping President Lagarde, maybe? She was in the news, in the media over the weekend, over the last week, Lisa, talking about inflation coming out of nowhere. Out of nowhere.
That doesn't really help her credibility. I mean, it's not like it's boom,
It just came out of nowhere.
It's Halloween.
Sure.
It's like come around the corner and say this boo. There is this question about how much they actually have their hands around inflation, and that's something that's not just for the ECB, but also for the Federal Reserve. How much credibility do they have to really say it's starting to roll over if you're not seeing that in the labor market?
Close to 11% on inflation in the Eurozone. Joining us now is AMH down in DC, Anne-Marie Hordern, our Bloomberg Washington correspondent. AMH, I actually wanted to start with the weekend's events in Ukraine and what's been happening with Russia. Russia suspending its involvement in that grain deal. Can you walk us through the importance of that and whether that deal is ultimately still operational?
Well, it's incredibly important and critical, as you heard from the UN, Turkey, the United States over the weekend, in terms of quelling that inflation you're talking about, especially when it comes to global food prices. And the President of the United States saying this is just going to create more starvation and hungry in the most vulnerable communities around the world. So over the weekend, Russia says they are coming out of this deal. What you saw immediately overnight is that wheat prices, soybean oil prices, all of this jumped on the news. You do see some shipments going, but the fact of the matter is, because a lot of this process takes a while to unwind, Russia says they are going to pull back on it. But we should note there was already a lot of concern in this marketplace because that deal was scheduled to end already November 19th. Now what you have is the UN and Turkey really running this offensive, this charm offensive with Moscow to say, please stay in this deal. Russia is saying that there was a strike from one of these Black Sea grain shipments. They also said the UK was involved without offering any evidence, and that is why they are pulling back on this deal. But there's a number of countries that are really trying to put pressure on Russia to stay in this deal because of the harm that it can do, especially going into these winter months.
And Maria, at a time when inflation is one of the top voting criteria that people are using as they head to the polls next week, how much is there starting to be a lot of pushback in terms of holding the line, remaining pretty much hard with Russia, and keeping some of the tension ratcheting up at a time when it is causing prices to go up and potentially really threatening the food supply of many nations?
Well, I think that debate and that tension, Lisa, was on display just last week when these progressive Democrats released this letter that they worked up over the summer, and they had to take it back and retract that letter that said that if we're going to continue sending billions of dollars, whether it's military aid, financial aid, to Ukraine, that alongside that there should be some sort of diplomatic outcome, or at least a path or a goal to have diplomacy. And that was quickly absolutely tear down about their own party, and they had a ton of backlash on it. So I think there is that question floating around whether or not it's the progressives on the left, or you had potentially going to be the next speaker, Kevin McCarthy, talking about the fact that when the House is taken over, in his prediction and most of the other polls' predictions, by the Republicans next week, that they say that there will not be a blanket check for Ukraine. And a lot of that has to come down with the fact, as you're saying, there is a lot of pressure on lawmakers to quell rising inflation, whether or not it's grocery bills, whether or not it's rent. These are concerns of the voters, and you see that in poll after poll. This is what is going to get a lot of people out and wanting to vote in this election.
There's a larger issue here, which is basically how much economic pain are you willing to tolerate for national and international security? And it's not just with respect to oil and grain deals with Russia. It's also with respect to Germany and China. It's what's going on where they're setting a coalition over to China on Thursday from Germany to possibly shore up some of the ties there. How much is there unity among some of the Western allies, especially heading in some really contentious midterm elections, to really push that through, even though it does cause economic hardship?
Well, when you're talking about China specifically, there's bipartisan support, and China is always an easy scapegoat and punching bag to get voters rallied up, and what is used by many lawmakers. When it comes to Germany and their ties with China, I think Jonathan one day put it very well. Germany, outsourced their energy to Russia, their economy to China. And at this moment, what you see from the Biden administration, they have these export controls on China. There was just a call overnight, Monday morning, Beijing time, about this. China pushing back on these export controls. China saying that the United States is trying to suppress their economic growth and future. And what you've seen from the Biden administration is that they want this multilateral approach, meaning the United States, Western Europe, and other allies on board with making sure they are competitive and tough on China. But at the same time, you see cracks when you see the likes of Germany maybe sending over a delegation. But we'll see where this comes, because also, of course, we have the G20 coming up right after the midterm elections, and we're going to see President Biden potentially sitting down with Xi Jinping.
AMH, wonderful to hear from you. We'll touch base with you in the next hour. Anne-Marie, down in D.C., did you see the president's comments before the weekend on the oil companies? Check this out for a quote. Granted, it was done at a fundraiser. You'd expect this kind of rhetoric, I'm sure. They talk about me picking on them. They ain't seen nothing yet. That's the rhetoric coming from the White House towards the energy majors over the weekend, Lisa.
Yeah, taking a hard tone. Perhaps it's just that, taking a hard tone. I don't know what else he's going to do. Is it windfall taxes? What can they actually push through before the midterm elections?
No idea.
And, at this point, how much does this really hold any sway versus just campaign rhetoric?
Well, it's campaign versus policy. Those excess profits are going back to their shareholders, their executives, instead of going to lower prices. How much of those profits would they like to go to shareholders, and how much would they like to go to lowering prices? Do they have a number in mind? Is there a percentage that is fair, that is unfair?
Part of me just ignores it, because I'm just thinking campaign rhetoric, and then they came out with a very specific number in terms of the downside risk for crude at which they'd start buying. So maybe there is. Maybe you're onto something.
Do
maybe
they have
there
a
are some
price
very
in mind?
specific numbers that they are going to unveil.
When Tom and I went down to DC a number of months ago and we talked about central planning, tell us your number.
Yeah.
What's your number if you've got one? What's fair? Futures right now down 0.5% on the S&P. From New York, this is Bloomberg.
boys, go.
After hardly a full year of name, image, and likeness deals being a reality, UCLA quarterback Chase Griffin already has more than 20 deals with major brands, venture, and charitable groups, all while balancing graduating undergrad in just 2 years and fighting for playing time on the field.
Chase Griffin out of the gun.
We are joined by UCLA quarterback Chase Griffin, not just UCLA quarterback, but name, image, likeness superstar. I am psyched for this one.
This kid could actually be the president of the United States someday.
When it comes to building generational wealth, it's not about the money that you make in college. I'm very excited that I made the amount of money that I made last year. I am even 10 times more excited that I know how to make that money.
Welcome to the world of decentralized finance.
I'm going to take a look right here at regulation.
We are seeing digital currencies under some pressure.
Bloomberg's covering all things crypto. The people.
I want to have some of my money outside of the sovereign.
The transactions.
It all comes down to the details here.
And the technology.
How does that affect disruptors like you?
What happens to everything that you're investing in when the last Bitcoin is mined?
Bloomberg Crypto, Tuesdays.
From New York City this Monday morning, here's the price action on the S&P 500. Big week of gains last week on the S&P, a week of gains of about 4%. Futures this morning negative 0.5%. On the Nasdaq, down about 6 or 0.7%. Last week, yields lower as well. Real yields much lower. Nominal yields too, down 20 basis points on a 10-year, just north of 4% on a 10-year yield right now, up to 4.06%. Yields higher by around about 4 or 5 basis points. More data still to come this week, including the ISM Fed decision on Wednesday. We've got to talk about Eurozone CPI. Check out the euro. Eurozone CPI earlier this morning came in very close to an 11 handle after breaking through double digits in the last month or so. We were looking for something close to 10%. In the survey, 10.3. The actual number, Bramo, 10.7 on euro dollar. 10.7 was CPI. And euro dollar right now is 99.36.
It came out of nowhere. Where did it come from? It's just a mystery.
Just miraculous, the
It's
inflation
just a
story for
miraculous
President
situation.
Lagarde and this ECB.
Yeah. Well, how much is this also because of the weaker euro? I mean, how much are they basically importing inflation because of the strong dollar with relation to their currency, and how much do they address that with policy? How much can they? Do we hear about that in some of their rhetoric? We didn't really hear that last week, but they kind of have to address that.
How can we talk about a downshift in policy with numbers like that in inflation still coming out of Europe, still coming out of the United States?
Unless you start to adjust your target for where inflation ends up. And if that's the case, that would be a rethink. You're laughing, but this is what people are thinking may happen tacitly. Even though Fed officials say if we do that, it would be a disaster. That would end up eroding a lot of our credibility, and it would get carried away because people would then put the peg that much higher above what we're saying the new target is.
I think it would make it tremendously difficult to achieve even that target.
Right, but
if they went from 2 to 3.
Correct.
Just because I wouldn't believe them. Then they'd be talking about 4. When 5, they have it with 6.
This is the reason why people are saying there's going to be a pretty steep downturn in Europe and beyond, because there is no other option. If things are still climbing in terms of inflationary reads and the economy is still chugging along, well, then how much do they have to do in order to really stop that?
Futures right now down 22 on the S&P. We're down about 5 or 0.6%. Andrew Hollenhorst, the City, joins us now, the chief US economist. And Andrew's just been fantastic through the whole of this year. I have to say, Andrew, congrats to you and the whole of the team, because I remember when you first came out with those calls for 50 basis point at every meeting, then 75, and everyone started to laugh, Andrew, and it quickly became consensus. Where are you now going into year end as the rest of the pack on Wall Street talks about a step down and financial conditions start to ease?
Yeah, thanks so much, Jonathan, and thanks for having me on. For our base case, we still think that the Fed might end somewhat below 5% policy rates, but we would not be surprised by levels above 5%. I think anything up to 5.5% would not be too surprising at this point. And, it really goes back and kind of thinking all the way back in terms of why this Fed has been more hawkish and why we're getting higher policy rates. It's what you were just talking about it in the European context. We just have inflation data that continues to surprise to the upside, that continues to push policy rates higher.
How do you think the chairman navigates this conversation in the news conference, Andrew, this week, given that they don't have the forecast? There's no fresh SEP until December.
It's really difficult in December. You do have a lot more variables that you can use to try to guide towards a step down in the pace of policy rate increase, but at the same time not trigger a loosening of financial conditions. And I think we saw a little of that last week as the market got excited about the fact that the Fed might be slowing the pace from a 75 basis point hike at this week's meeting to a 50 basis point hike in December. And we think that is what's going to happen. And that's not necessarily a dovish outcome. The hiking 50 basis points is still a larger than usual sized hike. The Fed could continue to hike at those larger sized hike sizes for an extended period of time, get to higher policy rates. So there's nothing inherently dovish about hiking at a slower pace. What the Fed needs to do is communicate that. And you're right, at the December meeting, there's a summary of economic projections that can show higher dots, suggesting that policy rates will move higher. It's really just going to come down to communication in the press conference at Wednesday's meeting. Ken Powell talk about slowing down the pace, but still indicate resolve on fighting inflation.
What's more damaging for the economy? Getting to 5% or 5.5% and then cutting perhaps 6 months later, or getting to 4.75% and holding it for 2 years straight?
I think what would be damaging for the economy, and I think to their credit, Fed officials have recognized this, is to allow inflation to persist at levels that are well above target. I mean, you were just talking and, we're kind of joking about the idea, could we get a 3%, 4%, 5% inflation target? But implicitly, that's what happens if the Fed continues to miss on their inflation mandate. If you continue to miss to the upside on inflation, then you embed in the economy a higher rate of inflation. And I think we're already seeing some of the costs, some of the uncertainty associated with not knowing how much wages, how much prices will be going up. That's the real risk for Fed officials. And that's why stopping too early is a risk and could imply actually hiking further at a later date. So you do have upside risk, you have downside risk. It's a complicated scenario. I think the primary risk right now is still the risk that inflation remains too high.
Andrew, you said something really important there, that by basically undershooting inflation again and again, they're basically communicating that inflation is going to remain higher than their target. This sort of speaks to what Diane Swank was talking about, their projections being fantasy land. How much do you think they've already done that by not really communicating some sort of downturn or something that is more realistic according to the economists' projections in terms of what kind of pain needs to happen in this economy to get inflation under control?
Yeah, I think it would be helpful if Fed officials concentrated a little bit more on the fact that labor markets likely need to loosen significantly to bring down inflation. It's a very unfortunate reality. It's a reality that nobody wants to be dealing with. But the empirical fact is that to bring inflation down from levels like the levels that we're seeing in the US and Europe, elsewhere, involves a significant loosening of the labor market. And that's almost a euphemism for saying the unemployment rate rises. Millions of people who currently have jobs no longer have jobs. That's a horrible outcome for the economy. That is the cost of inflation that's too high. And the issue now is minimizing the further cost of that. So I think that's right, Lisa. I think there should be more direct communication about the pain that's associated with bringing down inflation.
Andrew, I can sense even you're hesitating to say it out loud. And we do too around the programme, around the table on surveillance every single morning. And Andrew, I think they've still got to do a better job of communicating this. And it's not for me to do it for them. Andrew, how do they tell us that higher unemployment is a price worth paying to get inflation down? What's the answer to that?
Yeah, it's a very hard message to deliver, frankly. And I think that the answer is to be clear, be forthright, to talk about the historical evidence, talk about the theory. The theory that we have, when you look at the employment cost index last week, up 1.2% quarter on quarter. This is well above a pace of wage increase that would be consistent with 2% inflation. And so I think that's just one indication, a very tight labor market that's going to drive inflationary pressure. There's strong theoretical reasons, there's strong empirical reasons to think that that doesn't change without a loosening of the labor market. So I just think that we need to be clear and forthright about that. And to your point, Jonathan, it is an unfortunate reality. And I think that means that Fed officials and others have been reluctant to comment on it openly.
Andrew, we get unemployment data on Friday. We get the jobs report in America. Right now, I'm looking at payrolls. The survey, the median estimate about 190 from a previous 263. Andrew, can you tell me, as the year has progressed, have you sensed that perhaps this unemployment rate needs to go higher than you thought it did at the start of the year?
So I think there is a sense that maybe the unemployment rate doesn't need to go higher, but the amount of restriction needed in the economy may need to be more to get to a higher unemployment rate. So we think that the unemployment rate may need to get to something around 5.5% to bring down inflation. That would be a lot higher than 3.5% where we are now. Historically, it wouldn't be as high as what we've seen in other recessions. So there is some good news there if you want to see it that way. I think that the issue is the labor market data continues to be very resilient. 190,000 new jobs in a month is going to be strong enough to continue to put downward pressure on the unemployment rate. So we have a tight labor market generating wage pressure that's too high, and that labor market looks like it may be tightening further. The only evidence to the contrary, job openings, the JOLTS job openings numbers, those have started to come down. We get a new reading on that this week, so I think that's going to be important. But overall, low initial jobless claims, there's just a lot of evidence that this is a labor market that has not slowed sufficiently to bring down that wage pressure.
JOLTS data coming up tomorrow with the ISM as well, and then onto the Federal Reserve on Wednesday, and onto the payrolls report on Friday. What a week. Andrew, thank you, sir. As always, Andrew Hollenhorst there of Citi on the latest and what they're looking for from this Fed this week and perhaps beyond as well. As we were speaking, I got this message from Bank of America. Matt Dezok is going to join me a little bit later, and here's the line. I think the line captures this conversation almost perfectly. The Fed signaling the pause actually makes the pause less likely. That's the dilemma, Lisa, that this Fed faces later this week.
Which is the reason why people are talking about how could they signal some sort of pause and make it hawkish, right? How could they signal a pause, but then also say, oh, but by the way, we're also going to hit a 5.25% Fed funds rate, or we're going to keep raising for longer, or something to offset the potential rally that you get, the easing in financial conditions on the heels of that.
I keep going back to the communication, though. You get the sense it's shaped by the politics of the moment. How did they say exactly what Andrew was talking about? And even on Wall Street, you get the economists talking about what the Fed is trying to achieve, and they're dancing around it too, because it's just something you don't want to say out loud. This Fed is doing exactly what Senator Warren and Senator Sanders are worried about, trying to get unemployment up to get inflation down. That's the pain that Chairman Powell talked about at the back end of August in Jackson Hole, and it's still something I think is very difficult to communicate.
Well, perhaps there is a bigger question around all of this. Has the possibility of a soft landing gone off the table, right? And Mohamed El-Erian said there's still a small chance that possibly you could avoid a recession. Can we get a situation where participation rate starts to pick up and productivity starts to pick up, and suddenly you compensate for the gap and you get some sort of natural easing out of some of the pressures in the labor market? It seems like maybe that ship has sailed, and that's what people are, I think, are not willing to say right now.
Do you remember the positive supply side surprise we were all hoping for 12 months ago? Remember September 2021? We all thought perhaps it would kick back in, and it never did. On the commodity market, Amrita Sen, Director of Research at Energy Aspects. We'll catch up with her shortly. Right now, futures down about 0.5% on the S&P. We're down 21. Live from New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. In Brazil, the results of the presidential election signal a change in direction for Latin America's largest economy. Luiz Inácio Lula da Silva was elected in a dramatic comeback for the left-wing politician. 3 years ago, he was in a jail cell on corruption charges. Lula narrowly defeated incumbent Jair Bolsonaro, who has neither conceded nor commented on the results. His reaction will be closely watched by investors. Today, there's a showdown at the U.S. Supreme Court over affirmative action. Justices will hear arguments on admission policies at Harvard and the University of North Carolina. The schools are battling an interest group that wants to overturn precedents that let colleges consider race when they choose students. The CEO of Barclays says the lender's investment banking operation is critical to its success. CS Venkatekrishnan spoke to Bloomberg in his first television interview since taking the job a year ago.
The investment bank has been what has kept Barclays flourishing and quite apart from many of our competitors in the fact that, we performed extremely well during COVID. We are able to have a more diversified business model.
Last week, Credit Suisse confirmed it is looking to downsize its own troubled investment bank after multiple losses. And in the UK, the economy is shuddering to a halt under the weight of the biggest increases in borrowing costs in more than 3 decades. And there's concern that rates will go even higher. Economists and investors expect that on Thursday, the Bank of England will raise its benchmark lending rate by 0.75 of a percentage point to 3%. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
The satellites have propulsion systems. They can kind of move to get out of the way of each other or change their orbit a little bit. It's a service that you guys offer to help these companies know how to maneuver their machines.
Yeah, we offer a collision avoidance service. It's a subscription service. We'll send you an alert up to 7 days in advance if your satellite's going to come dangerously close to a piece of debris or another satellite.
Companies have been doing that for decades, moving satellites around, but it's sort of like a harder problem now.
The risk of a collision is a lot higher now, just because we've installed so much more hardware into space. You have a big collision, it creates a cloud of debris, and now all the other satellites are flying through this whizzing mess of debris. As we add all of the new satellites into space, the risks of the collision, the likelihood of the collision is going up.
Power, policy, politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect.
How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg. Multi-trillion-dollar industry. There's a lot of ground to cover.
Prepare for an economic hurricane.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Today on Bloomberg.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
the extraordinary investment by the United States and the extraordinary investments we've just heard from the United Arab Emirates and others is just not enough. This is a global crisis, and therefore requires global solutions. So regardless of where you are on the energy spectrum, we must all invest and innovate towards achieving a more decarbonized net zero world.
Amos Hochstein there, the US Special Envoy for Energy. Live from New York, here's the price action for you. Going into a massive week stateside once again. I say that every single Monday. But it is Federal Reserve week, so give me a break. Futures are down 0.5%.
I wasn't going to give you a hard time. I'm
giving myself a break.
Okay, good. Please carry on with that.
Yields up 4 or 5 basis points on a 10-year, 4.0582%. Euro dollar down about 0.4%. If you're just waking up, tuning in, CPI out of the Eurozone. Eurozone CPI close to 11% at 10.7. The survey was 10.3. The previous number was 10. The ECB has a problem, 99.29 on euro dollar, down by about 1/3 of 1%. I want to finish on crude. WTI 86.41, down 1.7%. Prince Abdulaziz bin Salman was speaking at an investor conference in the Saudi capital, Riyadh, last week. And this quote, I saw this quote all over Twitter, all through last week. And lots of people messaged me and said, please talk about this. And I've waited, and here we go. People are depleting their energy stocks, their emergency stocks. They've depleted it. They've used it as a mechanism to manipulate markets, while its profound purpose was to mitigate shortage of supply. Now, if the messenger wasn't Prince Abdulaziz bin Salman, then maybe we take the latter part of that quote a little bit more seriously. But when OPEC starts talking about manipulating markets, maybe people stop listening. But the final line, I think the final line is worth our time. The profound purpose of some of these stockpiles, and we're talking about the SPR here, is to mitigate a shortage of supply. Now, do we have a supply emergency in the energy market that has required the kind of SPR release that we've seen from this administration over the last 9 months?
Well, Republicans are investigating this. This is something that a lot of people would debate, especially because this administration themselves have come out and said, our objective is to lower prices, right? At what point does this become an economic argument that's feasible? I'm not going to weigh in on that. What is clear is that the politics are clouding the fundamentals at a time when China is actually declining in terms of momentum pretty quickly. And how much is that going to ultimately be the driver one way or another, regardless of the political back and forth?
I just think ultimately we've got to talk about how it sets us up for next year, for the next 12 months in the oil market.
Yeah. Well, in other words, how vulnerable is the United States if there actually is a shock and suddenly there is a shortage of oil production? And that's something that's very relevant.
Amrita Sen joins us right now, the Director of Research at Energy Aspects. Amrita, can we start there? Typically, we talk about the near-term story. Let's get out to next year just briefly. How vulnerable is the United States now with the SPR at a 4-decade low?
I think it's a great question. We've calculated this, and even before Prince Abdulaziz said this last week, we kind of highlighted the fact that right now the SPR is actually being used to pretty much influence prices, whereas its objective was very much for supply mitigation. So remember, the SPR also has legislative releases that was agreed back in 2017. So that's another 100 million barrels that's going to come out. We'll end the year, this year, at just below 400 million barrels, about 380. Deduct another 100 from the legislative releases over the next 3 years. It doesn't leave the administration with much more than 60 million barrels, we believe, that they could do without running into issues with the IEA's at least requirement to have at least 90 days of net import cover. Now, of course, you can continue to run it down below that number, but I will say this again and again, that this is a time of energy security, and running down SPRs to influence prices is probably not the most prudent strategy.
Do you think it leaves America even more exposed to the whims of OPEC next year?
If you don't have SPR, or rather, let me rephrase, if you were using SPR to offset supply disruptions, that's very different. But if you're using SPR to just keep a cap on prices, then yeah, absolutely, because we've said this before as well, but if you are going to use the SPR to combat OPEC, that's like turning up to a gunfight with a knife, because OPEC has millions of barrels per day of production that they could cut or raise, where the SPR is ultimately a finite volume, which also will need to be replenished at some stage.
Amrita, given the fact that there isn't this relief valve of the SPR that potentially could be tapped in a major way next year, and given the fact that OPEC Plus has that leverage over the U.S. and other nations, Are we ever going to see $72 a barrel kind of price levels where this administration said they would like to refill the SPR?
We don't think so. No, I mean, if anything, 5th of December, when the EU embargo on Russian crude starts, that's when you're going to see the real supply disruptions kick in, because this is about shipping disruptions, right? We're just having to tie up so many ships now to move Russian crude all the way to the east. We will start to see some Russian productions shut in, and that's only going to get worse next year. So we just do not see how we get down to the 70s unless and until the economy really collapses and China doesn't actually start to get better, which we expect should start to happen from April next year.
Amrita, based on some of the supply disruptions that you're expecting heading into the winter, and we are getting signs that, you know, it has been mild so far, but the UK, there are just reports that they could see a colder winter than usual. Where could you see oil prices going, and how does that translate to gasoline prices at this highly political moment?
I mean, look, we are expecting prices to go towards $100 pretty into the year end, and really trade into the 110s and 120s for most of next year. And the biggest upside, like you mentioned, is the winter. Of course, weather is always going to be erratic, and nobody can really predict weather. But even otherwise, stocks are just very, very low. Now, you do ask about gasoline. It's a fair question. Gasoline prices in the U.S. have continued to rise because there's so many refineries that are still down. And let's not forget the French strikes that are still ongoing. We're not producing enough, but I will highlight it's diesel that we need to be really worried about. Diesel stocks are at near record lows. We just haven't built over the summer, and that's what we tend to use in the winter if it does get very, very cold. And I think that's a much bigger concern for the administration right now. So we are expecting potentially some form of intervention by the administration, maybe saying you have to hold X amount of diesel stocks in the New York harbor before you can export from PAD 3.
Amrita, I've got about 40 seconds on the clock. I want to squeeze this in. We've been talking about this now for the best part of, 8 months? Call it 9 months, close to. Amrita, have you seen any effort, either from Europe or the United States, to build out refining capacity in a material way?
No, quite the opposite. And it's a great question because, if anything, Europe is talking about windfall taxes on refining. And this is going to be the biggest bottleneck. Next year, we have a few Middle Eastern refineries starting up. But after that, after 2025, we just don't have enough refining capacity to meet oil demand.
And that right there is the problem. Amrita Sen, thank you, Director of Research at Energy Aspects. Thank you. We talked a number of weeks ago about having a meteorologist on the show instead of having an FX strategist. Did you ever think you would see the FX market move on a weather report?
I mean, that's basically what we've been saying for the past couple of months, and that's what happened, because you see them say that perhaps you get a colder winter than usual in the UK. That's a game changer for the pound.
Sterling just off session lows, 115.42. We'll catch up with James Athey on the weather in London, in the UK. I mean, seriously, investment director at Aberdeen is going to join us shortly. Futures on the S&P 500 down about 0.6%, live from New York, on radio, on TV. This is Bloomberg.
What about cryptocurrencies? Are you a believer in cryptocurrencies?
No, I'm not a believer in cryptocurrencies. And I would say that cryptocurrencies are a bubble. And I would describe cryptocurrencies as a limited supply of nothing. So to the extent there's more demand than the limited supply, the price would go up. but to the extent the demand falls, then the price will go down. There's no intrinsic value to any of the cryptocurrencies, except that there's a limited amount.
Well, based on what you've just said, why would you not put a big short of some type on cryptocurrencies? Or maybe you have, but do you think that's a good short?
Well, you know, when we look for these subprime, the reason why we shorted these subprime in size because it was asymmetrical. You're shorting a bond at par that has a limited duration that trades at a 1% spread of treasury, so you can't lose more than the spread in the duration. Yet if it defaults, you can make the par amount. In crypto, there's unlimited downside. So even though I could be right over the long term, in the short term, as the case of Bitcoin, you know, went from 5,000 to 45,000, you know, I would be wiped out on the short side. So it's just too volatile to short.
Welcome to the world of decentralized finance. Bloomberg's covering all things crypto, the people, the transactions, and the technology. Bloomberg Crypto, Tuesdays.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is going to be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
The markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Earnings coming in is just another data point that people have to absorb to try and understand this narrative.
The source of the negative surprises this quarter has been, in fact, weaker margins than was anticipated.
The market is consistently underestimating the level of inflation by anywhere from 50 to 150 basis points.
The Fed has been leading the most recent push higher in global rates.
Everybody wants to channel their inner Volcker. You better be careful you get what you wish for in a levered system.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Coming off the back of a truly impressive week of gains on the S&P, live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowitz, I'm Jonathan Farrow. TK taking a day off for Halloween. Happy Halloween, TK. Futures, a negative 0.4% on the S&P. I say truly impressive last week, Lisa, because Meta got slammed, Amazon got hammered, Microsoft and Alphabet not a whole lot better.
So basically this idea of possibly the Fed could, I'm not going to say it, but maybe reduce the pace of the increases of their rate hikes. I mean, honestly, no, I can't. You're going to say, this isn't going to be the step-down show, so it's not going to be the step-down show. It's going to be reducing the pace of the rate hike show. And how much are they basically going to provide wind to a market with communication of just that fact, even if you do get earnings that come in weaker than expected?
So the big challenge, how do you do that? How do you achieve that without triggering a premature easing of financial conditions? And is that what we saw in the last week?
You know, maybe, kind of, but sort of. I mean, we didn't really see any bold moves. If you look at where yields are, they still are around the same levels, and you're still getting about a 5% Fed funds rate next year. If they communicated that they were going to hold rates, they were going to go slower so they could hold rates higher for longer, given the maturity cycles, given how much people need to whittle down some of the savings that they have, that would cause more weakness in this economy than just getting it up to a higher point sooner. And so at what point do people understand that?
In that opening of this program for this hour, you heard Lindsay Piegza there of Stifel talking about inflation surprises, not just in America, in Europe too. A little bit earlier this morning, about 60 minutes ago, we had Eurozone CPI at close to 11%, at 10.7. That's up from 10 in the previous read.
How much of this is because of the weaker euro? How much of this is because of some of the disruptions that have been ongoing in China? How much is this because of the $1.7 trillion in savings over what they would otherwise have that U.S. consumers still have stockpiled in their bank as a result of some of the programs during the pandemic? How much is that feeding into this higher than expected inflation that continues around the world?
You mentioned China, the data out of China over the weekend. Not impressive. Downside surprise. We'll pick up on that a little bit later. Futures right now recovering off session lows, down about 1/3% on the S&P 500. Yield shaping up as follows. Higher by 2 or 3 basis points, backing away from the highs of the session at 4.0374%. In the FX market, euro dollar looks a little something like this. 99.38. We're negative about 1/3% on euro dollar. A softer euro story. I want to talk about crude briefly. 86.57. WTI Bramo down about 1.5%.
I'm Rita Sen just saying she sees it going to about 100 by year end due to some of the supply constraints and a winter that could be colder. We'll get the weather report coming up. This week, we are looking at a whole host of rate decisions, starting with the Reserve Bank of Australia. That will be tomorrow. The FOMC rate decision on Wednesday really is the key one. How are they going to communicate that they will eventually, as planned, be reducing the pace of rate hikes? And where is their end point? Do they start to communicate the amount of pain that this economy is going to have to feel? And similarly for the Bank of England, although they've got a very difficult decision on Thursday. This week, we also get a slew of economic data, including the employment report that comes out on Friday for the month of October. But before that, tomorrow, the JOLTS report for the month of September might hold more clues in terms of how much softening you're getting. This is the job openings. Are we seeing that sort of soft not hiring that could indicate perhaps a bit of a loosening in this labor market? And then, the earnings really are important. And this week's earnings may be particularly important because they are focused in retail and they are focused in healthcare, some of the areas that have gotten bid up, not retail as much as healthcare. Almost 1/3 of the S&P 500, 160 companies on deck to report. I'm looking at Uber in particular. How long can we keep ordering $20 salads and getting them delivered? I'm just wondering, John. I mean,
is that what was on your mind over the weekend?
I'm just wondering, how much people are going to start to push back and not necessarily take that,
I think last week we talked about how much investment had gone into food delivery and how insufficient investment had gone into things like taking energy out of the ground and building refining capacity and all of those things. I think I saw a quote in the Wall Street Journal over the weekend. It's about investing in real things again. And I think you've talked about that as well over the last 9 months.
Well, and you're seeing this in the tech earnings, right? Have we witnessed massive tech bubble? And when you start to see the deflation of that and the money come out, what's left? And how much does that really lead to some sort of bigger economic deterioration versus an idiosyncratic pothole that allows everything to keep on climbing?
What we all find frustrating is the politics and the difference between politics and making good policy. You hear all these complaints about getting energy prices down, but to catch up with Rita Sen of Energy Aspects about 10 minutes ago and ask her, have the Europeans or the Americans spent any material time trying to build out refining capacity this year? And they are multi-year projects. And you haven't seen it in a profound way. That's deeply frustrating. What do you expect to happen if you don't build out refining capacity? Where do you think this is going to end up?
Or is this a communication problem where they could have been saying to their consumers, to their people, hey, listen, oil prices are going to be higher. Gasoline prices are going to be higher because we have to invest in a whole host of other energies in order to get to a new reality. If they can't say that, it's going to become a really tenuous moment where you don't invest in what you need right now.
Well, I think politicians want the bridge to the next election and wanted somehow OPEC to provide that bridge for them, as if that was going to happen.
I feel like you just have this real faith in politics right now, John. I feel like you've had this, just pure sense of lack of cynicism.
Well, I have this deep frustration with politicians.
You think?
Regardless of party.
Yes, I know that.
That has existed for a long, long time. James Athey joins us now on the weather, investment director at Aberdeen. James, serious question. Let's start there. How important is the weather going to be for your calls in this market over the next 3-4 months?
We're Brits. We love to talk about the weather, John. Of course, the weather features heavily in all of our investment debates and discussions. Obviously, putting aside my attempts to be facetious there is a direct linkage between some of these government programs and the weather. The extent to which we need a lot of gas, a bit of gas or not much gas will largely depend on to what extent we can be a bit more frugal about using it, but also obviously how cold it is and how much we need to heat our homes. And if governments are capping prices, that means they're on the hook for all of the wholesale price above which they're capping. So it is important. It's difficult, obviously, to factor that into an investment strategy strategy. So I think it's just a risk that one has to be aware of.
James, how does the Bank of England respond to the weather report?
Well, the Bank of England's response to its core mandate has been near impossible to try and fathom on a month-by-month basis. So I'm not even going to attempt to link Bank of England policy to the weather. I'm sure they will feel better today than they did, 6 weeks ago in terms of the stability of markets, the stability of government policy. But really, the problem facing them hasn't changed much from prior to the mini budget. Inflation is still incredibly high, and their strategy is still to hope that the coming recession clears the decks.
James, you've been pretty bearish over the past year, and you've been cautioning everyone on this higher inflationary regime, tighter Fed policy, tighter global central bank policy, and the potential for pretty severe losses. We've gotten them. Are you starting to get more bullish? Are you starting to see more opportunity in what's been baked in?
I mean, I guess yes and no. Obviously, when stuff gets cheaper, it looks more attractive than when it was expensive. But my concern certainly with US equities, my concern today is not valuation as much as it is fundamentals. The earnings expectations that are baked into current stock prices still look way too high to me if we're talking about a recession in 2023, which I think we are. If we're talking about just a US recession, that'd be one thing, but we're probably talking a global recession, and we're certainly not talking about China in the immediate future coming out of zero COVID or looking much more healthy in terms of its growth outlook, or indeed in terms of its political priorities towards growth. So I just see this huge quantity of global headwinds, and the US market is still discounting 5 to 10% EPS growth for 2023, and that just looks way too high. So I still think the underlying earnings picture needs to come down a heck of a lot, and that would be a double whammy if inflation comes down along with growth.
So James, you're not alone. We hear that a lot. We haven't seen capitulation. What does capitulation look like is something I want to know. What does it look like?
Well, for starters, we have to have nobody talking about tradable bear market rallies. Throughout this bear market, we've had a number of commentators, market participants talking about opportunities to buy this market, because actually underneath everything, fundamentals are still okay, and once the Fed has stopped getting in our way, we can just get back to perennial growth. And I think normally when you see a capitulation, you struggle to find anybody anywhere that thinks it's a market that you want to buy. So psychological capitulation, I think, looks different to the extent that there has already been not necessarily capitulation, but certainly extreme bearishness amongst participants and commentators alike. I don't think it's necessarily played out in positioning. I think people are talking more bearish than they're actually investing. And I think that's something that we need to see shift as well. Actually, a shift in underlying allocations towards equities, or sort of away from equities towards bonds, because the relative valuation story there is as attractive for bonds as it's been in some time.
James Anthony of Aberdeen. James, good fun as always. Good to catch up with you, mate. Thank you, sir. Futures right now down by 0.4%. I want to pick up on something James said. It's been a feature of this conversation on this programme for a number of months, in fact, through much of this year. There is still this belief we go back to what we were doing before, pre-pandemic, back to the old regime in the market, low growth, low inflation, low rates, and get long growth equities. That still exists. I hear that a ton. I hear that a lot.
Yeah, and then you've got people pushing back and saying that you're going to get a lost decade, because that's not the case, and inflation remains high, and people say, okay, the sky is falling for those people, always disregard. So at some point, you have to get some sort of understanding of where we are. The Fed could be instrumental in that, in terms of their guidance, because if they actually come out and they say, we still think soft landing is possible, well, does that basically signal the opposite, and that they're going to underplay where inflation is going to be at for longer?
Lost decades aren't unheard of. I don't think it's consequential. I don't think it's controversial to say there might be a lost decade within an asset class. You look at the banks after the financial crisis, you look at tech, look at Japan several decades ago. I don't think it's controversial to say it.
Have you been speaking with someone called Hugh Henry?
We had a good chat last Friday.
It was a great chat. It was really good, but he has some pretty dire projections.
He's a deep thinker.
He is.
He's dragging me down with him a little bit.
Yeah. I know, I can feel it today.
Somewhat philosophical over
the
weekend. I think Hugh's right. Hugh's right. No, that was just my thoughts and not my conclusion. Futures down by 1/3 on the S&P from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. In Brazil, it's a dramatic comeback for former President Luiz Inácio Lula da Silva. The left-wing politician has won the presidential election, narrowly defeating incumbent Jair Bolsonaro. 3 years ago, Lula was in a jail cell on corruption charges. Bolsonaro has neither conceded the race nor commented on the results. His reaction will be closely watched by investors. In Ukraine, the government says Russia launched a massive wave of missile strikes across the country. Part of the capital, Kyiv, was left without water and electricity. Now, the attacks came after Russia pulled out of a deal that allowed millions of tons of Ukrainian grain to be exported. Russia withdrew after accusing Ukraine of attacking its warships. In South Korea, the government has opened an investigation into one of the country's deadliest incidents in years. At least 154 people were killed when a crowd squeezed into a narrow alley during Halloween festivities. Reports are that some people began to fall, causing others to tumble and pile onto one another. In Western India, at least 130 people were killed when a suspension bridge collapsed. The disaster happened in Prime Minister Narendra Modi's home state, Gujarat. The colonial-era bridge had been reopened last week after renovations. And inflation in the Eurozone has surged to an all-time high. Consumer zone jumped by 10.7% from a year ago in October, and that was much higher than the median estimate in a Bloomberg survey. Meanwhile, Eurozone GDP rose 0.2% in the third quarter, and that beat estimates, but was much less than the 0.8% gain in the second quarter. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Lisa Mateo. This is Bloomberg.
Fascinating entrepreneurs because you also started really young. What did you learn? Did you always think that you'd be an entrepreneur?
Probably, yes. I think, which is a bit sad,
From
isn't it?
age, what, 5,
Well,
6?
maybe, I'm not sure. I come from a family of entrepreneurs, so even though I probably can spell the word and still can't occasionally, it's sort of in my blood. But it's really fun starting a business. And fun growing a business. I feel it's a real privilege. And I started my business officially at 18, but I think I knew I wanted to do it very differently from about 15. But I'm sure it's, if you're surrounded by it, it feels very natural. So yes, it's
and
fun.
And it started how? You started by you went to Florence. It was in Italy, and you started handbags.
Yeah, so I knew I was actually given a handbag by my mother when I was about 16, one of her old handbags, and I remember how it made me feel, and I think fashion is fascinating for the mood-changing, the confidence-boosting aspects, and the sort of tribal aspects of what fashion does. And so I went at 18 to Florence, knowing that was the home of leather goods, which is what interested me. I just wanted to learn, actually, and be surrounded by craftsmen who, making things is important, and that's going to be very interesting, I think, over the next sort of 10 years. I think the onshoring of craft and manufacturing is going to be fascinating, actually. I watched the offshoring. I literally saw it, and I think we're going to be seeing that coming back to local. We have to. When we're all looking at our objectives in terms of carbon, proximity is going to be key.
Business is you get to build things from nothing.
I don't have any investors. All this is all money in. This is me just building it.
It's pretty much full service shadow banking with nobody in charge.
What's happening on Wall Street?
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights
We think that's the next secular shift.
from businesses most influential and instrumental.
It's knocking it out of the ballpark.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
From New York City.
We're in London, in Sydney,
In San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
How
story.
are you thinking about those dynamics?
Earnings season is here.
The earnings are starting to pour
The
in.
numbers are holding up better than expected.
Sorry, business isn't all that bad.
Bloomberg breaks the numbers first.
Netflix earnings going to cross the wire.
A big beat. Stock is up more than 8%. Coming in stronger than their rivals.
With exclusive expert analysis.
Finally back to growth.
The mother of all opportunities.
What is the industry to watch?
That's where the rubber hits the road for Goldman Sachs.
It's going to be a really interesting earnings season.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
The political pressure is a counterproductive strategy from the point of view of those who launch it. Frankly, the Fed doesn't listen, and if anything, feels more pressure to prove its independence. So they don't influence short-term rates and what the Fed actually does.
What a tightening cycle we've seen already from this Federal Reserve, and we're set to get another 75 this Wednesday. That was Larry Summers, the former Treasury Secretary, on Wall Street Week with David Weston over the weekend. Futures look like this on the S&P 500, down 1/3%, just bouncing off the lows. Yields are higher by 2 or 3 basis points on a 10-year, 4.0395%. A little bit earlier this morning, talked about this a few times already. Upside surprise on Eurozone CPI. Inflation in Europe coming in hot, 10.7%. The survey was 10.3. The previous read was 10%. That's a Eurozone inflation story. Let's get to the prospect of more inflation still to come. Over the weekend, Russia exited a grain deal with Ukraine. This is what they've had to say just now, just seconds ago. So let me work through these headlines with you. This from the Kremlin spokesperson, Dmitry Peskov, said the Black Sea grain deal can hardly continue without Russia. Goes on to say, without Russia, the shipping grain under the deal would be, quote, much riskier. They are in talks with Turkey, with the UN over the grain deal, and of course Turkey and the UN fundamental in striking this deal earlier this summer, Lisa, but at the moment Russia suspended their involvement in it. We also know, based on our reporting this morning, that vessels have continued leaving with grain. Whether that continues, though, without Russia's participation remains to be seen.
And let's be clear what this means. That basically, if you're going to be operating a ship, that you don't know whether you're going to get bombed down if they're not part of this perhaps safe agreement, right? And that's sort of the issue here, is that how do you guarantee safe passage of essential food for many places in this world?
Well, at the moment you can't, and that's the problem. And AMH has been all over this story over the weekend, I know. She joined us now from DC. Anne-Marie, go through it piece by piece and tell us what you've heard from the White House and how they've responded to this.
Well, the White House, alongside the United Nations, Turkey, they want to see this deal continue, Jonathan, because of the issues regarding inflation and the fact that really Ukraine has just this outsized proportion in the world when it comes to grains, especially to these communities in Africa and the Middle East. So they want this to continue. Over the weekend, the Russian Defense Ministry, and I read the statement myself alongside their telegram, talked about the fact that they said there was a drone strike, and they think potentially it came from one of these Black Sea grain ships. They also said the UK was involved. They gave no evidence of any of this, but they said because of this, we are pulling it out. Now, many would say this was always going to be a potential because they had that November 19th deadline to renew this agreement, and potentially some people were thinking the way Putin has played politics with natural gas and oil, he may again play politics with grains because he knows how critical this is to the global economy, to the crop market, and to global inflation, which is hurting the West tremendously. But Jonathan, as you mentioned, we do see some of these ships still leaving the port. The issue is, will it continue? And you're going to see a lot of background negotiations between the United Nations and Turkey, which are on the forefront of trying to salvage this deal.
What does this mean in terms of the U.S. exporting additional grain to stave off, to make up the difference for nations that might be running short?
I mean, there's potential of that. There's been around the world from these Western allies the hope to want to step in and help, especially when it comes to things like fertilizer in Latin America that has really pushed up prices. But at the same time, Lisa, back to every other commodity, every country is facing this similar issue. So you also can see potentially others wanting to hoard all of the either grain or fertilizer they get a hand on so they can lower their own country's food inflation numbers.
Why would Russia want to do this? I mean, what is in it for them? Are they actually thinking of terrorizing some of the ships, or is this basically a negotiating tactic to hold some of these grain supplies hostage?
Well, we just don't know. What we do know is that they said because of this strike that they are immediately pulling out of a deal. That could be them just using this as leverage or potentially creating more problems for the West, which have very harsh sanctions on Russia. And some of those sanctions, like export controls, which we saw the United States and their allies put in place in February and March, they're now starting to be seen. When you see airlines in Russia that are flying a tremendous amount of routes domestically, but cannot get the parts they need because of export controls, you're starting to see some of this bite. And we're going into the winter, and Putin knows that what is top of mind for every single Western leader is inflation. Look at the European numbers today, a fresh record, exceeding expectations. Look at what's happening in the United States. The number one issue that you have individuals coming out, the Democrats are likely going to lose the House for, potentially the Senate, is inflation. So he has the world right now exactly where he needs them to put more pressure when it comes to these basic commodities like grain and like commodities like natural gas and oil.
1 week to go, Anne-Marie, 1 week to go for the midterms. How does this all play into it?
Well, this will be part of the inflation story. I also think potentially if you do see numbers start to tick up even more in the United States because of what is going on, you may see more pushback. Like we heard from Kevin McCarthy saying there's not going to be a blank check for Ukraine anymore. And then you heard from progressive Democrats, which then they retracted. But the notion is out there that they said if we're going to spend these tens of billions of dollars to Ukraine, there needs to be a diplomatic pathway. I think, though, Jonathan, what you will for sure see over the next course of the couple of months, maybe some disagreement on the fringes, but the most majority of the United States politicians do want to have a bipartisan front when it comes to making sure they are implementing punishments on Russia, but at the same time securing and helping their friends in Ukraine. But the blowback is going to be difficult if it really starts to hit their constituents.
Anne-Marie, just one final question, if I may, and it's been a lead story quite rightly over the last few days here in America. The health of the Speaker's husband. How is he doing now?
Well, he does seem to be doing better and recovering. Speaker Pelosi put out a Dear Colleagues letter over the weekend thanking everyone for their support and just talking about the fact that her family, their grandparents are really, this was so traumatic that their pop is what she called him, was attacked in this way. And Jonathan, it took center stage on the Sunday shows yesterday, and really you saw the Republicans come out and really attack what went on, saying that there is no place for this type of violence in politics. At the same time, we also, though, heard from the Republican National Committee chair saying the fact that crime is going up and this criminal could still be back on the street. So that's one way that it's being spun. And then from the Democrats, what you really heard is the fact that they are linking this attack to political rhetoric from the right and from the individuals that are more the extreme part of the right that support the former president, Donald Trump. This will be a key part of the midterms next week.
MH, looking forward to your coverage of it. Anne-Marie down in Washington. Anne-Marie Hordern, our Washington correspondent. Futures right now down a third of 1% on the S&P. We're going to catch up with Michael O'Rourke in just a moment, the chief market strategist at Jones Trading. Push forward to a Federal Reserve decision later this week and tons of economic data as well. Futures down, yields higher from New York. This is Bloomberg.
Hydrogen has a very special place in the universe. It's the first element on the periodic table. It is the most abundant element in the universe. And when clean energy advocates think about what can we find which would be as easy to use as fossil fuels, they think about hydrogen. The fuel that will, when burned, only produce water.
We like to imagine that if we just built enough of these and these, we could ditch fossil fuels and save the planet. Unfortunately, it's not that simple. There are some things where you just need a good old-fashioned combustible fuel. Now startups around the world are betting that hydrogen can become the fuel of the 21st century.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become chief future officers. Duke Energy has an ambitious plan to transition to clean energy, and new CFO Brian Savoy is ready to lead the charge.
We're going to invest $145 billion over a decade. There's a lot going on, but I wouldn't have any